Hello everyone, I hope you guys are doing well and your studies are going in full swing. Now in today's video, we are going to discuss about arguably one of the most challenging and one of the most scary topics for a lot of CA final students, that is consolidation. Now this is a chapter which is very important. It is definitely a tier 1A category chapter, and most of the times when a question comes from this, it is a 14-mark compulsory question. And because of the sheer size of the question, this kind of scares a lot of students. Having said that, truth be told, if I compare this with a financial instrument or some other complex topic, I would say consolidation is much more manageable if you practice it properly. It is process driven, so once you know the steps, you know the important adjustments, and you will be able to address this question flawlessly. So please ensure that you watch this video till the end. Get consolidation's fear out of your mind. Okay, so that is our objective. We'll discuss all the concepts, all the steps, all the logics, and all the important questions as well. So this will act as your reference point when you want to do consolidation. Now before we start, it would be great if you can like the video and if you can subscribe to the channel if you have not already, because that kind of will help you in getting all the notifications. Okay, so I hope you have done that, and with that we can start with consolidation. First, consolidation of subsidiaries covered by Ind AS 110. Consolidated financial statements are statements of the entity that is a parent company along with its related entities, the group entities like a subsidiary where the entity has control, or even a joint venture where it has joint control, or an associate where it has significant influence. Now there are separate standards covering a joint venture and associate which we can review separately, but in today's session right now we are focusing largely on the subsidiaries part. So when an entity prepares its standalone statements, like Reliance prepares for it, its subsidiary like a Jio is a separate entity, and hence it will show it as an investment. However, for all practical purposes, Reliance Industries and Reliance Jio are one and the same, and as a result, Section 129 of the Companies Act mandatorily requires every entity which has a subsidiary, for example, to prepare a consolidated financial statements which is treated the parent and the subsidiary as one and the same. So how do you prepare consolidated financial statements? Well, Section 110, Ind AS 110 gives you a method called as a full consolidation method, and we are going to study about the features of the full consolidation method. Well, just for reference, if it is a joint venture or a joint operation or an associate, there are different methods. Like in associate, you have the equity method, in a joint venture also equity method, and in case of a joint operation, a proportionate consolidation method. But currently we are focusing largely on the full consolidation method. For joint ventures, there's a separate video for which I'll share a separate link as well, which you can refer. Okay, when you look at full consolidation, what does it mean? It means that, well, all the assets, all the liabilities of the subsidiary will be fully consolidated, which means Reliance actually has a 70% stake in Jio. However, when it has to consolidate the assets and liabilities, it will consolidate the entire 100% of the assets and liabilities of Jio. The logic being that I have the control over the assets, which means, for example, if I have 100 acres of land which is there with Jio, can Reliance decide what is to be done with only 70%, that is 70 acres, or the entire 100 acres? Well, Reliance can decide what is to be done with the entire 100 acres, whether they want to sell them, renovate them, whatever. It will decide whatever is to be done with the entire 100 acres, and hence Ind AS 110 says that when you consolidate, you will consolidate 100% of your assets and 100% of the liabilities of the subsidiary, irrespective of how much stake, let's say 70% that you hold. And this gives birth to the concept of non-controlling interest, because you're consolidating 100% of the assets when actually 30% of that belong to someone else, and hence you create a non-controlling or a minority interest. So first of all, in the full consolidation method, all assets and liabilities will be 100% consolidated irrespective of the stake that you hold. Secondly, consolidation will start from the date when you obtain control. Simplistically, you can say control is the date when you get the ability to direct relevant activities. From a student perspective, largely you can look at the date when there is more than 50% stake, and you will keep on consolidating till the time you lose control, that is largely till the date when you lose the ability to direct relevant activities. So consolidation will start from the date when control is acquired and continue till the date control is lost. Now for your reference, there's a separate Ind AS 103 as well, which is on business combination, which gives you guidance on what is to be done on the date when control is acquired. So it is like saying that when you look at Ind AS 101 on first time adoption, it will give you guidance on what is to be done on the transition date. On that date, what is to be done, and then you follow regular accounting standards. In a similar way, Ind AS 103 gives you specific guidance on the date of acquisition. On the acquisition date, how should you account? But once the acquisition date is done, after that, the subsidiary can keep on earning profits. There can be a lot of other transactions. how will those transactions be accounted for? The guidance for that is given under Ind AS 110. Okay, so we said that all assets and all liabilities of the subsidiary has to be consolidated under the full consolidation process. However, I might be owning 70% in the subsidiary, 30% is held by someone else, for which you create something called as a non-controlling interest, which was earlier called as a minorities interest. Now, this can be created by either following fair market value, like looking at the market price or the fair value of the shares of the subsidiary. Let's say the fair value of the shares of the subsidiary is 50 rupees and there are 1000 shares. 30% of that is, let's say, 300 shares which are held by people other than the parent, and each of these shares are worth 50 rupees. So 300 into 50, for example, will be 15,000, which will be the market value or the fair value of the non-controlling interest. Now, that is one of the methods in which you can calculate non-controlling interest. Other method is, rather than looking at the market value of the share of the subsidiary, you can say that we are taking over assets and liabilities of the subsidiary. 100% of the assets and liabilities, and let us say these assets and liabilities, that is a net assets after taking all assets minus liabilities, comes to, for example, 50 or 40,000. So if I look at 40,000 being the net assets of the subsidiary, 30% of that 40,000 is belonging to someone else. I've consolidated 100%, the entire 40,000, but out of that 30%, that is 12,000, is attributable to someone else, and hence you create a non-controlling interest for that 30%, that is 12,000 will be the base on which you will create the N.C.I. So over here, N.C.I or the non-controlling interest can be created. The shares of the subsidiary's equity which are not attributable to the parent should be shown as an N.C.I, and as per 103, you can either value it using the fair value method or the proportionate net assets method. In an exam, you will typically take the proportionate net assets method unless the question specifically tells you that you have to solve using the fair market value method. We have done this in Ind AS 103 business combination. Again, at the cost of repetition, what happens is, in case of a fair market value method, the goodwill that's created is called as a full goodwill. It is a goodwill which is belonging to the entire company, that is a parent and N.C.I both. Whereas the goodwill that created using proportionate net assets is called as a partial goodwill, which is belonging to the parent only. So sometimes a question might tell you that the company has taken a choice of following the full goodwill method, in which case the non-controlling interest will be measured using fair market value, or company has taken the choice of following the partial goodwill method, in which case the N.C.I will be calculated using the proportionate net assets method. Loosely speaking, if you have to remember, P for partial goodwill, P for proportionate net assets, F for full goodwill, F for fair value for N.C.I. Okay, so for this we usually create a separate working note for calculating non-controlling interest. Now, the special things in case of a consolidation is, well, there's nothing big in assets and liabilities. We are just going to take them together and join it, land joining it, inventory joining it. However, you have to create a non-controlling interest. Also, what happens is, in case of a parent, in its SFS, standalone or separate financial statements, it would have shown an investment in the subsidiary. Now, when I take over all the assets and liabilities of the subsidiary, I cannot also show an investment. Remember, I was earlier showing an investment because it is an SFS, so I would say that subsidiary is different, parent is different, but now parent and subsidiary become one and the same, in which case I can't show an investment in my own self. Okay, so I will have to eliminate the investment which was appearing in the parent's books, which is attributable to the subsidiary. So, for example, I have done an investment in the subsidiary worth, let us say, 40,000. So, or let's say 38,000. So, I will say that I'll have to eliminate the investment. But like you did in your CA intermediate amalgamation, etc., when there's an intercompany debtor and creditor, there will be a debtor in one of the books, there will be a creditor in the other books. In a similar way, when I'm looking at consolidation, when Reliance says that I have a 70% investment in Jio, that means 70% of the share capital of Jio is attributable to Reliance, which means when I eliminate the investment, saying it is intercompany, it is an investment in Jio, the share capital of Jio, at least 70% of the share capital is attributable to Reliance, and as a result, fundamentally, 70% of the share capital, for example, is the same as those 70% shares which are held by Reliance, and hence it needs to be eliminated. But when I make an investment, I just don't get 70% of the share capital, I also get 70% of the reserves that were existing as on the date of acquisition. These reserves are called as pre-acquisition reserves. We will do these workings, we will do these steps, but I'm assuming over here that you are briefly familiar, if this is a revision video, not a first time viewers video per se. So there's a 70% of investment represents 70% share in the capital, but I will also get a 70% share on the reserves that were existing on the date of the acquisition. So if I am acquiring a company like Tata Motors acquires JLR from Ford, Tata Motors on the date of acquisition will get 70% of the share capital of the JLR, but at the same time 70% of the reserves that are appearing in Ford's books are also now bought or acquired by Tata Motors, and hence I will try to eliminate the investment against 70% of the net worth, which is the same as 70% of the net assets. So what I'm trying to say loosely is, I'm saying that for a 70% stake, I'm, let us say, paying 38,000. Now this company has a net assets of 40,000, 70% of 40,000 will come to, let us say, 28,000. In which case I'm saying that for something which is worth 28,000, I'm actually paying 38,000, and hence the additional amount that I'm paying, which is appearing as a part of my investment, will be towards the reputation, because control is acquired, and hence this is how you will calculate goodwill. Earlier in your CA intermediate, you used to prepare a separate account called as a cost of control account, which you can still continue to prepare, no problem in that. However, institute usually at final CA level shows the working in a working note in a tabular manner, and hence we will also try to prepare that. So I'm just initially discussing the principles, and then we will go on into the steps of consolidation where we are going to use and apply these principles. So we say eliminate the parent's investment in the subsidiary against the parent share in the subsidiary's equity that comprises of share capital less pre-acquisition reserves on the date of acquisition. The difference, if any, on such elimination would be shown as goodwill or a gain on bargain purchase or a capital reserve as the case may be, and for this we'll prepare a separate working note. Okay, now all of this is happening on the acquisition date, but the problem is after the acquisition date as well, subsidiary continues its separate legal existence, and as a result, subsidiary will continue to earn some profits. Let us say it earns 100 rupees worth of profits. Out of these 100 rupees, 70%, these 100 rupees are earned after acquisition. Out of this, 70% is still attributable to the parent, 30% of which is attributable to the N.C.I. Now, what will you do with the 70% of the profit? Well, will I eliminate it or will I consolidate it? The theory says you will consolidate it because this is a profit that is earned by you, which is under your control. Let's say Tata acquired JLR in 2010. Now in 2011, if some profit is earned, that is under Tata's management, and hence that profit should be consolidated along with Tata. However, the profit before 2010, that is before the date of acquisition, was already earned under Ford's management or the old company's management, and for example, when Tata pays a purchase consideration, it acquires the net assets and thereby the net worth. So profits up to the date of acquisition are actually purchased when I pay the PC. Higher the reserves that the subsidiary has, higher will be the PC purchase consideration I'll have to pay. But profits after the date of acquisition are not purchased, they are earned, and if they are earned, they can be consolidated. So we say that reserves need to be analyzed between what are the pre-acquisition reserves and what are post-acquisition reserves, and then they should be attributable to parent and N.C.I. because the reserves are distributed. Like assets and liabilities can be controlled, but reserves will be distributed, and when they are distributed, 70% of the reserves will go to the parent, 30% of them will go to the N.C.I. The parent share in the pre-acquisition reserves is adjusted against the goodwill workings, as a parent would have paid PC to acquire those reserves. So pre-acquisition reserves, you purchase them, and hence that will go in the working along with purchase consideration for goodwill, whereas post-acquisition reserves are earned and they will be consolidated along with the company's regular reserves. Institute usually calls the pre-acquisition reserves as capital profits and post-acquisition reserves as revenue profits, though you can simply call them as pre and post-acquisition profits. So these are capital profits, pre-acquisition, and the post-acquisition reserves will be called as revenue profits. Okay, so we prepare different working notes. So for reserves, you'll prepare working note 1. For goodwill or capital reserve, you'll prepare working note 2. And for non-controlling interest, you'll prepare working note 3. We will discuss the steps in the consolidation process, and this is where it is very, very important. Trust me, for consolidation, even if your consolidated balance sheet finally does not tally, you don't have to worry. No, there are causes for concern, but if you don't even have the time to complete your consolidation question, trust me, this working note 1, 2 and 3 that you will prepare for consolidated reserves, for goodwill, for non-controlling interest, they have their own share of stepwise markings. So depending on the complexity, I could say anywhere, at least up to 50 to 60% of your marks on a stepwise marking are given if you get your goodwill, your N.C.I. and your consolidated profit and loss or your reserves correct. So as long as you're getting these numbers correct, more than 50% of the marks of the problem will be given to you. So ensure that you don't just focus on saying that my balance sheet has to tally, where there has to be an important focus, but getting that stepwise correct also, there is a lot of opportunities to get your stepwise marks. Okay, so we will discuss the steps in the consolidation process. These are the steps that I follow. Again, different professors have different ways of solving. All of them will give you the same goodwill, the same capital reserve, the same consolidated balance sheet, but it is preferable if you stick to one preferable set of steps which can really help you in doing that in a multiple number of times. So over here, what is the steps that we follow? The first step you do is you prepare the Schedule 3 balance sheet. You look at the question, prepare an empty Schedule 3 balance sheet. That will be based on the balance sheet given in the question. Apart from that, there will be two new items that you will put in this balance sheet. One is the goodwill and second is the non-controlling interest, which may not be there in your balance sheet given in the question. So your step number one will just involve preparing a blank Schedule 3 balance sheet. While you prepare the balance sheet, at the heading, if you give the name, you say, let's say H Limited and its subsidiaries. And when you give the name of the balance sheet, you write the word consolidated balance sheet as on so and so date. So you'll prepare the structure of the balance sheet. Usually you start with preparing the structure. However, there may be certain questions, like if there are different accounting policies, or if there are different dates at which the balance sheet of subsidiary and parent are, or if there's a foreign subsidiary. Then before preparing the Schedule 3 balance sheet, you will prepare a working note and prepare a redrafted balance sheet of the subsidiary using the parent's policies, or at the parent's balance sheet date, or in the parent's currency. So that is these are the only questions where you might first have to prepare a working note to for getting the subsidiary's balance sheet in the parent's format, and after that you prepare the Schedule 3 balance sheet. Once you prepare the Schedule 3 balance sheet, you have to the question is very big. You have to narrow down the funnel in a very systematic manner. So what we prefer is, we prepare after that exactly a notes on your assets and liabilities. So when you prepare the notes on your assets and liabilities, you will take the same asset balance, same liability balance as given in the question. No sir, there may be adjustments. We will handle the adjustments separately. Currently, remember, these are two accounts which you are joining. So first you will have to give effect to each of the line items, and after that, whatever adjustments are to be done, we will do. We will take all assets, land, building, machinery, inventory, debtors, creditors, loans, everything, all assets, all liabilities, line by line, you will consolidate. So the format that you will prepare is, you will have assets and liabilities. You can prepare this in multiple ways. This is one of the ways which is very much possible, where you have the parents, you have the subsidiary, and you will make a column for adjustments and then the total. There are alternative formats possible. We will discuss that, but this is what we will do. Over here, you will take all assets, all liabilities, except for 5 specific items. You will not take the investment in subsidiary over here. You will take it separately. You will not take the share capital of the parent, share capital of the subsidiary, reserves of the parent, reserves of the subsidiary. Barring these 5 items, which will be there in the printed balance sheet, you will take every other item. So over here, you will take all assets and all liabilities. So once you do that, you have taken most of the balance sheet. After that, you have still not taken the share capital. Remember, share capital cannot be line by line consolidated. The share capital that will appear in your final balance sheet will be the share capital of the parent, and hence the next note will have the share capital of the parent. So out of those 5 things, share capital of the parent will be taken as a separate note. And then you will prepare 3 crucial working notes, working note 1, 2 and 3, leaving 10 lines for each of them approximately. So this is the crux of your solving. Working note 1, let's say consolidated reserves. Consolidated reserves, you will start with the standalone reserves of the parent. Remember, the parent's reserves will continue to appear in the final balance sheet. It is the subsidiary's reserves that need to be studied and analyzed. So over here, you will start with the consolidated other equity, working note 1, where we will start with the standalone reserves of the parent. You will write down the reserves as it is, leave around 8 to 10 lines, and then working note 2 will be cost of control or goodwill workings, as the case may be. Over here, how will you calculate the cost of control? Well, we will say, what are we paying to acquire control, where the investment that is appearing in the balance sheet. So you will take the investment balance over here. So this will be purchase consideration, which will be shown in the form of investment that will appear over here. So out of the 5 things that were missing, we said we will not take 5 specific things. Out of those 5 things, I can say share capital was taken separately over here, share capital of the parent, then reserves of the parent were taken over here. So now you are left with only the share capital of the subsidiary, reserves of the subsidiary, and investment. Investments will be taken over here, but this investment will be eliminated against the share capital of the subsidiary and the pre-acquisition reserves of the subsidiary. So over here, you will take the share capital, for example, of the subsidiary. Usually, if you are following proportionate net assets method, you will say that if there is 1,000 rupees worth of share capital, 1,000 means 70% will be attributable to the parent, 30% will be attributable to the minorities, non-controlling interest, and hence you will say that when you want to calculate goodwill, you will compare the purchase consideration with your share in the pre-acquisition reserves. I'll again repeat, you will compare it with your share in the pre-acquisition reserves. As a shortcut, you can always take purchase consideration, that is investment, plus the non-controlling interest as on the date of acquisition minus 100% of the net assets. But as a shortcut, for most cases where there is a proportionate net asset question, you can compare directly the purchase consideration with your share of the net assets or net worth, as the case may be, and your share will be 70%, but 30% will be attributed to the N.C.I. So over here, you will have share in the net assets. This is 1,000 worth of, let's say, share capital into 70%. Will be attributable to the parent, and 1,000 of share capital into 30%, that is 300 attributable to N.C.I. So technically your elimination entry will go something like this. It will be share capital account debit, for example 1,000, to let us say cost of control, that is goodwill workings, to non-controlling interest. So 70%, that is 700, will go towards the cost of control, and 30%, that is 300, will go towards the non-controlling interest. And when you are eliminating investment as a debit balance, you will credit it. So to investment, debit will go to, let us say, the cost of control. So over here, when we are looking at this, we will try to narrow down and say that this is a point where the only thing that remains in the question is the reserves of the subsidiary and all the adjustments given below. So we have tried to narrow down the funnel. There will be, let's say, a 14-mark question. Ideally, every mark will have approximately 2 minutes, so it should ideally get over in 28 minutes. A consolidation question does not get over in 28 minutes. Your job over here is to try to complete it in anywhere between 35 to 40 minutes, because I mean, if there was no restriction on time, you could have easily done a consolidation question, but with the pressure of time and so much to complete in so less time, I would say 35 minutes should be your ideal target, maximum 40 minutes where you complete the consolidation question, because if you take more time over here, it will eat up the other time for the other questions. So ideally, you read the question, you prepare the schedule 3, you prepare the notes to accounts. Well, technically notes, if you see the suggested answer of the institute, they prepare notes something like this. They see P.P.E, then P, then S, then the adjustments, inventories, P, S adjustment. If you have a bigger name, like one of the questions had a name as Hammer, as Sleek for holding company and subsidiary, every time you keep on writing that. Now that will take a lot of time. So you can safely follow an approach like this, where you can directly prepare a table where you write down all assets, all liabilities together, rather than writing the name of the company again and again. It will take a little more time, and those valuable 2 to 3 minutes, you can create magic at the end, right? So take study material has given you a format like this. We have seen institute giving marks for a format like this as well, so you can safely take that. So you will prepare the notes, then you prepare this 3 working notes. Working note 1, starting with standalone P&L of the standalone reserves of the parent. Working note 2, starting with the purchase consideration of or investment, as a case may be, and working note 3, where you start with the non-controlling interest. You see the question and figure out, before you do working note 3, whether it is a proportionate net assets method question or a fair value question. Both of them have slightly different format in working note 2 and 3, so you need to be a little careful. Currently we are discussing regarding proportionate net assets, in which case you will get to a point where you will sit to analyze the reserves. Now when you sit to analyze the reserves, I prefer you prepare a table. This table will have 4 columns. Assuming there is just a single reserve item, there will be particulars, then there will be total balance of the reserves, and you split it between pre and post. Pre reserves would be reserves at or before the date of acquisition. Post reserves will be reserves after the date of acquisition. So your format will be something like this: particulars, your opening balance will be opening balance or the balance as on the date of acquisition, as a case may be. This will be given somewhere in the adjustments. To that you add the profit. Why will that change? Well, profit after the opening balance or date of acquisition minus dividend minus bonus, if any, and this will give you the closing. This closing balance will be there in the balance sheet. So we are saying that this is one item that is yet to be remaining. Okay, we need to analyze it. Why do we need to analyze it? Because assets and liabilities are consolidated. Share capital and investments are eliminated, but reserves are not blindly consolidated. They are not blindly eliminated. A part of the reserves, like pre-acquisition are usually eliminated, but a part of the reserves that is post-acquisition are consolidated, and hence you need to analyze the reserves. So there will be a working note 4 where you said to analyze the reserves. Over here, you will first write down this format, take the total. We'll do it along with sums as well so that you have a better understanding. But balance plus the profit minus dividend minus bonus will give you the closing. Now, every item you will analyze, like the opening balance, most likely will go in the pre section because it must be up before the date of acquisition. Profit, you'll have to see whether the profit is post acquisition, partly pre, partly post. For example, let us say your opening balance is given on 1st April 25, date of acquisition is 1st July 20, and your balance sheet is on 31st of March 26, in which case the opening balance, which was still 1st April 25, is fully pre. However, the profit during the year, whatever you calculate, this profit will be split 3 months pre, 9 months post, and hence you will have to allocate. Further, if there is items like dividend or bonus which you will study, you will have to see the date when the dividend is paid, the date when the dividend is paid along with the source from which it is paid. If it is paid out of pre-acquisition profits, it may be paid on any date, but if it is paid out of pre-acquisition profits, the question can tell you that dividend of 10% is paid out of the opening balance. If it is paid out of the opening balance, well, opening balance is clearly pre, then the dividend is paid out of pre-acquisition profits. Or the question clearly tells you that the dividend is paid out of post-acquisition profits, then you subtract it from there. So you will allocate between pre and post based on the data given. Well, if nothing is given, it is safe to assume that the dividend must be paid out of post-acquisition profits, but if it is given to be out of pre-acquisition profits, you can assume that accordingly. The general assumption for dividend is it is paid out of the profits from which it is earned, like dividend of the year 2025-26 must be paid out of the profits of the year 25-26, or dividend for the year 23-24 must be paid out of the profits of that year. That is usually the assumption that people take. Okay, now once you allocate this, that is, you will split the balance which is given in the question between pre and post. However, you are still left with the adjustments. So leave another 8 to 10 lines for the possible adjustments and the split that is there. And this is where honestly your real question starts. So when you look at a 35-minute question, I would say anywhere between 12 to 14 minutes max, 10 to 12 minutes ideally, would be spent till the time you reach this stage. And the next 8 to 10 minutes are your most important things, after which you will again try to balance and post everything. So let us say approximately half of the time over here goes in making a format, and the more you practice, and whatever LDR questions that we are going to do, apart from a few other questions as well, if you practice a few on pen and paper and you get the process right, where you know that, well, I have to apply my mind at a very limited place, because initially I've just prepared a Schedule 3 balance sheet, then I've just copied the assets and liabilities which are there in the question, share capital of the parent, then 3 working notes I've done, one third of a page. I've started with the standalone of the parent, then I've taken the investment that was done by the parent, then in the non-controlling interest and in the investment I've eliminated the share capital, then there are reserves of the subsidiary, I've analyzed them, total, in the total column you'll have the opening plus profit less dividend, that gives you, let's say, closing. Allocate between pre and post, and this is a point where I've covered everything from the balance sheet and I'm just left with the adjustments, and I need to study these adjustments properly. So I leave 8 to 10 lines and then prepare a working note 5. Now I prefer that for these adjustments, there are around 10 to 12 adjustments in total. There's nothing beyond that. 10 to 12 adjustments, out of which 3 of them are the most important, 4 of them are the most important and common. That is the fair value adjustment, dividend adjustment, upstream, downstream of inventory adjustment, and chain holding. Most of the questions that I have seen revolve around this. There may be a few other adjustments here and there for which you can practice, but if you are having a grip of these 4 or 5 adjustments, then mostly institute makes a question kind of rearranging these adjustments here and there only. So we'll make a working note 5 where we will give effect to the adjustments, and from your 11th and 12th early college days, you have been taught that what is given in the trial balance or the balance sheet has one effect, but what is given in the adjustments will have 2 effects. And hence, I personally prefer that you in rough write down a journal entry when you want to give the adjustment. Now again, passing that journal entry is not mandatory. Institute at most places does not do that. So do I need to do it in the exam? Well, if you do it, no one is going to deduct marks, but at least you will know what are the double effects to be given. If you even don't want to do it, you just want to show the working and solve, most welcome, you can easily do that. But for a wider understanding, I will try to review the journal entries as well. Okay, so over here we will review the journal entries for all the adjustments that we are just going to go into, like the fair value adjustments, upstream, downstream inventory adjustment, dividend adjustment, bonus adjustment, uniform accounting policies, different reporting dates, various items. We will try to look at those adjustments, give the effect. You can do intercompany eliminations, debtors, creditors, etc. And after that, after everything is done, that is the next 10 to 12 minutes. So you will split your 30 minutes approximately, 30 to 35 minutes approximately into 3 parts. The first part where you read the question and make the structure, second part where you handle all the adjustments, third part where you total up everything and give the effects, and the last part where you are totaling and praying to God that your balance sheet tallies. Okay, so over here we say that while solving the balance, leave around 10 to 12 lines, prepare working note for adjusting entries, and workings need to be mandatorily shown, though entries can be passed optionally. And last is totaling and closing, where you in the reverse order go. You total up your working notes. Let's say you'll find the total for your working note 4, then working note 3, 2, 1, then total up your notes and then prepare the balance sheet. Now the point that you want to remember is, for example, let us, I'm just taking hypothetical numbers, your opening balance was 100, let us say your closing balance is 200, profit during the year came up to also 100, let us say, and your date of acquisition was let's say 3 months after the opening date, in which case I'll say 100 is the opening balance, 25 over here will come as pre, 75 will come as post, and that's about it. So you've analyzed and said today the reserves are 200, out of which 125 was earned prior to the date of acquisition and 75 was earned after the date of acquisition. Now let us say there were no further adjustments, in which case what will I do with this 125? Well, this 125 belongs 70% to the parent, so into 70% belongs to the parent, that is around 87.5 belongs to the parent, and the remaining, for example 37.5 belongs to the minority. Similarly, 75 into 70%, for example, belongs to 52.5 belongs to the parent, and the remaining 18 or 22.5 belongs to the minorities. Now whatever is belonging to the minorities will go in the working note 3. So in the minority interest, I will say minority has access to 30% of the share capital, plus minority also has access to 30% of the pre-profit and loss, plus 30% of the post profit and loss. If there are other reserves like general reserves, retained earnings, etc., it also has access to 30% of all the other reserves, and that will give you, in simplified terms, a non-controlling interest. Okay, however, for non-controlling interest, you don't really bother whether it is pre or post, it is belonging to the minorities. However, when you look at the profits attributable to the parent, we would say a part of them will be purchased and should be compared with the PC on the date of acquisition. Like for example, the profits which were there of around 125, they were there as on the date of acquisition. You have not earned them, but if this is 125, it would have been 1250, you would have to pay more PC if there were more profits on the date of acquisition, and hence this 87.5 will go along with working note 2. That is for goodwill workings. So when I do the goodwill workings, I will say that, well, I've paid this purchase consideration, but this is against getting a share in the net assets. Like in business combination, what happens is you have the balance sheet as on the date of acquisition only, and hence you can directly compare the purchase consideration with the net assets. But in case of a consolidation question, what will happen is you will almost certainly not have a balance sheet as on the date of acquisition. You'll have a balance sheet maybe a few months or years after the date of acquisition, and hence to find the net assets on the date of acquisition is very, very difficult. It is not possible, and hence you take a proxy. You say that, well, you will not be able to find the net assets. Then let us say we try to find the net worth, because asset minus liability is equal to share capital plus reserves. So we take a proxy. We say that, okay, in consolidation type of questions, when your balance sheet is a few months or years away from the acquisition date, you will try to find and back calculate what the net worth must be on the date of acquisition. That must be the net assets as on the date of acquisition, so that you can calculate the goodwill properly. So we say that as on the date of acquisition, there was some share capital, there were also some reserves. So 30% of the share capital belongs to the N.C.I, 70% of the share capital attributable to the parent. Similarly, 70% of the reserves will also be attributable to the parent. 70% of the pre-acquisition reserves will go in the goodwill working, because these are the reserves that you must have purchased. However, 70% of the post-acquisition reserves will directly be taken into your consolidated P&L, because that is something that you have earned. So over here this 87.5 will be taken while calculating goodwill. Now when you look at this 52.5, this is what we studied. We said that this is parent share in the post-acquisition reserves. These are earned by you, and if they are earned by you, then you will have to take it along with your consolidated profit and loss. So when you calculate your consolidated profit and loss, I will add the share in the post-acquisition profits, for example, of the subsidiary. This will come from this analysis. So basically the objective of analyzing reserves is to find the adjusted reserves for the purpose of consolidation. Whatever are the pre-reserves, 70% of them is attributable to the parent, it will go along with the goodwill working. 30% to NCI will go along with NCI working. Whatever the post reserves, 70% attributable to the parent will go along with working note 1, that is consolidated profit and loss. 30% of that will go to the NCI as well. Okay, so that will give you your analysis of the reserves. Now the only challenge that will come over here, and this is a fairly daunting challenge, is what will happen if NCI is to be calculated using the fair value method. Now over here what does happen is, for example, if I were to look at NCI using the fair market value method, here what I am doing is I am taking the NCI as share capital, 30% of the share capital, plus NCI share in the pre-acquisition profits. So whatever of the pre-acquisition profits, 125 to 30%, plus pre-acquisition other reserves. So I will try to find the proportionate share of NCI in the pre-acquisition net worth. Okay, now NCI will keep on changing even after the acquisition date, because the company may make profit after acquisition and NCI has a share in that profit as well. So NCI will keep on changing after the acquisition date. However, on the acquisition date, how do you measure NCI? Well, one of the methods is proportionate share of NCI in the pre-acquisition net worth. Another method is the fair market value method. Now in the fair market value method, a fair market value will directly be given to you, in which case you don't need to do any of these workings. We will directly take NCI on the acquisition date as the fair market value. In which case, when I look at the NCI, I will directly start the NCI at the fair market value as on the acquisition date. But remember, when NCI is using fair market value, the goodwill calculated is the full goodwill. So in that goodwill, you will have NCI's share of goodwill as well as the parent share of goodwill as well. The earlier working that we did, this was partial goodwill, that is, you were taking only the investment you have made and the share in the net assets you have had. Now some people say that in business combination we do it differently. We do it as PC. Let us say PC was 1000 rupees for, let's say, a 70% or an 80%, whatever, 70% stake, plus NCI minus net assets. Now I don't know what the net assets are, but let us say the net assets were let us say 1200 rupees. In which case NCI over here is going to be 30% of that 1200 only, which means this is going to be 360, and hence if I try to calculate the goodwill, this goodwill over here will be 1360 minus I think 1200, and hence the goodwill will be 160 rupees. However, my point over here is, rather than doing PC plus NCI minus net assets, for which I will need the net assets as on the date of acquisition, I will have the net assets given as on the balance sheet date. I don't have it. So a shortcut over here, what Institute does is, instead of taking net assets, it takes a net worth. It says it is easier to find the reserves as on the date of acquisition rather than finding all the assets and liabilities again as on the date of acquisition. So you will find the net worth, in which case NCI would still be 30% of the net worth. So if I were to put an equation, this is PC plus NCI minus net assets is equal to goodwill. Now NCI over here in proportionate net assets is 30% of the net assets only. So this is PC plus 30% of net assets minus net assets equals to goodwill. If I take net assets common, this is PC minus, let's say, 70%, that is your share of the net assets, that will give you goodwill. And hence what I try to do over here is, I compare the purchase consideration directly with my share in the net assets or net worth as on the date of acquisition. That will give me goodwill, but that can only work if the NCI is using proportionate net assets method, this shortcut. If NCI was calculated using the fair market value method, in which case the NCI is not 30% of the net assets, in which case if the question is a full goodwill question, there have been multiple questions that have come in the exam which are partial goodwill questions, multiple questions which have been full goodwill questions. So if it is a full goodwill question, how will the solution change? Well, you will start with PC in the same way. But rather than subtracting my share of the net assets, I will first add the NCI. Sir, which NCI? NCI, which is the fair value as on the acquisition date. So these are the two effects for the NCI at fair value. First, you will take it into working note 3 for finding the opening balance of NCI as on the acquisition date. To that second effect, you will say that when I calculate goodwill, I can't just calculate goodwill based on the purchase consideration. That will give you a part, only my share of the goodwill, to which I will add the NCI. Now, since I have taken the consideration for both 70% as well as 30%, I will not take my share of the net assets. Now, I will take 100% of the net assets, which means when I am doing the working, the entire 100% of the share capital. Sir, usually I give 30% to the NCI, but now that is not needed because I have directly taken the fair value of NCI on the acquisition date. I don't need to, it can't increase further because of the share capital. Okay, so the entire share capital will be used in my working note 2. Further, my reserves, my pre-acquisition reserves, I was earlier splitting those pre-acquisition reserves between the parent and the NCI. Now, when I calculate NCI at fair market value, I've already taken the fair market value. I will not again add the NCI. I will not again add to the NCI the share in the pre-acquisition reserves. If the fair value is, if the reserve share was higher, the fair value would have automatically been higher. However, when I am looking at the goodwill, I can't just compare the 100% with my share, that is 70% of the reserves. I'll again have to take 100% of the reserves. So, the thing that you will change when a full goodwill question comes is your step number 1, preparing schedule 3 balance sheet, same, notes to accounts, same, working note 1, consolidated reserves, same. But when you go to working note 2, your purchase consideration cannot be compared with your share of the net assets because that will just give you a part of the goodwill. You want full goodwill, which means to the purchase consideration, you will have to add NCI's, fair market value. And similarly, in the share of the net assets, you will not just take your share, plus you will also have to take NCI share, and hence 100% of the net assets. You don't have net assets, so you take net worth. So over here, you have pre-acquisition P&L, pre-acquisition reserves, etc. And this will give you your full goodwill. This goodwill will be the full goodwill, whereas the goodwill over here above, if you go to see, this was, let us say, your partial goodwill. So when I look at working note 1, till working note 1, there is no change. In working note 2, you will add the NCI after PC and then subtract, instead of share of net assets, 100% of the net assets, that is net worth, on the date of acquisition. In working note 3, when you start the non-controlling interest working, you will start directly at the fair market value. You don't need to separately give your share in the equity share capital, your share in the pre-acquisition reserves, because the entire fair value is taken. And when you prepare working note number 4, your entire working till the end will remain the same. It is just that in the end, when you split the reserves, you will still say that in the post-acquisition reserves, 70% of those post-acquisition reserves will go to the consolidated profit and loss. This is attributed to the parent. 30% of the post-acquisition reserves will still go to the non-controlling interest. These are post-acquisition reserves. But when I look at the pre-acquisition reserves, the entire parent share as well as NCI share is now sitting inside working note 2 only. So over here, the entire pre-acquisition reserves, both the parent share as well as the NCI share, will go to working note 2 for the goodwill working only, because I have taken the entire NCI as on the acquisition date over here, and hence I will take both 70% and 30% of the share capital, 70% and 30% of the pre-acquisition reserves in this same working. So this is a few things that you have to remember if the question is a full goodwill question or a partial goodwill question. Again, you do it with sums and numbers, it will be more clarity. Again, it's a very, very big chapter. We want to kind of quickly revise it in the best possible time, and hence this is helpful if you kind of have some background of the consolidation process. Okay, now we'll focus on the consolidation adjustments. So we will discuss regarding one of the basic adjustments, which is, can your non-controlling interest be negative? Now in your schedule 3, where will you show the non-controlling interest? Well, when you prepare your schedule 3 balance sheet, non-controlling interest appears as a part of your NCI, as a part of other equity. So when I prepare my schedule 3 balance sheet, and this is difference between AS and Ind AS. If you remember, your AS balance sheet, minority interest was left hanging between the shareholders fund section and non-current liability section. You would prepare shareholders funds, share capital, reserves, then a separate line item for minorities, and then a separate heading for non-controlling interest. So you are not treating, you did not know how to treat it, and hence AS kept it hanging. Ind AS says there is a financial instruments chapter where there is a definition of equity, which is an instrument which evidences residual interest. Now, a non-controlling interest, equity is not defined as someone who has voting power or someone who can control. Equity is defined as any instrument which has residual interest, and N.C.I. has the residual interest, and hence when you look at N.C.I., this N.C.I. will be shown as a part of equity. Non-controlling interest is a part of equity, and items within equity can very well have a debit balance. If you remember in CA Inter, when you did internal reconstruction, you would have huge profit and loss debit balances. These are accumulated losses. Like a shareholder fund item can have a negative, that is a debit balance. A liability cannot have a debit balance, and as a result in Inter CA, maybe at AS21 level, you were told that minorities have to stop at 0. No. Under Ind AS, N.C.I., which is a part of equity, can have a negative, that is a debit balance, because, well, it's a part of equity. Like a P&L can have a debit balance, a N.C.I. can also have a debit balance. So over here, if your company is making losses, and on account of those losses, the share in N.C.I. is turning up to be negative, under Ind AS, you don't have to worry. You can very well have a negative, that is a debit balance in the N.C.I. So as N.C.I. is a part of equity, it can have a negative or debit balance. No separate adjustments are needed for the same, and hence the adjustment is fairly basic. Now, a very important adjustment in case of consolidation, which comes in most of these questions, is a fair value adjustment. That is, when you did business combination Ind AS 103, you were taught that you will compare the PC, that is a purchase consideration, with the fair value of the net assets. Now, if I look at my consolidation, what happens is there is a company P whose balance sheet is given, there is a company S whose balance sheet is given. Now, your date of acquisition may be 1st of April 25. However, this balance sheet may be given on 31st of March 2026. Now, what happens is when I look at, let us say, the land, I look at the buildings, inventories, etc. This is as per S's individual balance sheet, that is S's SFS. Now, the problem over here is, if someone comes and acquires a controlling stake in S, it is just a change in shareholding. S Limited continues its separate legal existence. Like when you look at a company which is listed on the stock exchange, every minute, every second, every hour, shares are changing hands. Does that mean the company will keep on changing the fair value of its assets depending on what shareholder thinks what is the fair value of the land? No. The company will account for its land, building, etc. as per Ind AS 16, and it will continue to record it, let's say, using cost model, etc. So S will continue to show in its balance sheets the land at its, let's say, carrying value, which was 100. However, on the date of acquisition, let us say the fair value of this land, for example, was 500. This is on 1st April 25. Now, Ind AS 103 says that when you prepare the CFS is a separate set of financial statements of P and S combined. When you prepare the CFS, in the CFS, you will take over the land at the fair value, that is 500. That does not mean in the SFS of the subsidiary, you will have to remeasure the land. In the SFS of the subsidiary, the land continues to be at 100 only. So when you prepare your consolidation steps, you prepare your balance sheet, you prepare the notes. In the notes, you will take over the land of the subsidiary as was it appearing in its books, that is 100. However, when I prepare the consolidated balance sheet, let us say of PS adjustments, in my CFS, the land should not appear merely at 100 rupees. In subsidiaries books, it is appearing at 100. On the date of acquisition, the land was worth 500, and hence the value of the land will be higher as per Ind AS 103 on the acquisition date. So, from an accounting perspective, you will debit the land. You will debit it by what? 400. This is increasing the value of the land to bring it in line with the fair value on the acquisition date. Now, the problem is, what will you credit? Now, a student might say that you will credit the revaluation reserve or a fair value reserve or any kind of reserve. My point is, the name of the reserve does not matter. Why? Because this is a profit that was already earned till the acquisition date. The land must have been acquired by the subsidiary way back in 2010 for 100 rupees. Now, in 2020-25, this land became 500 rupees. So, this increase of 400 already happened prior to the date of acquisition always, because this is the increase in fair value up to the acquisition date. This increase already happened up to the date of acquisition, and hence these reserves will always be pre-reserves. And in my final balance sheet, I don't consolidate the pre-reserves, I eliminate them, and hence the name of the reserve does not really matter. In which case, what we will do is, in line with what Institute does is, we adjust these balances along with the retained earnings. Well, to be honest, you can very well create a separate account as well, like a revaluation reserve, but that will just increase your job where you have to analyze one more reserve. We said that when there is a initial fair value change, that will always go into the pre-reserves, because this is a change, whether it is higher or whether it is lower. This is a change which has already happened up to the date of acquisition, and hence this will be to pre-acquisition reserves. Let's say this can be the pre-acquisition P&L, retained earnings, whatever it is. This is 400. So these are the two effects. So first effect will be your land will increase by 400. So 100 plus 400 will become 500. The second effect is when you are analyzing the reserves, your net worth as on the acquisition date would be increased by 400. Why? Because the reserves, the net assets were higher as compared to what is there in your books by 400. So the net worth will also be higher by 400. And thereby, when you look at these adjustments, the fair value adjustments, you will say that as on the acquisition date, over here, adjustments on acquisition, there will be fair value adjustments, initial adjustments, which will impact the pre-column. For example, over here, your 400 might land up, and this will increase your adjusted balance, and thereby, if I was earlier believing that it is only 125 worth of balance which was there on the acquisition, 125 may be there on the books, but you take over the fair value of the assets and liabilities, and hence 125 plus 400, that is 525 will be the adjusted balance, and that 400 my share is of the parent also, of the NCI also, and hence you will split between parent and NCI. But you will have to remember that if there is any asset, whether it is land, whether it is building, whether it is machinery, whether it is inventory, on the acquisition date, if its fair value is different as compared to its book value, you will have to do a fair value adjustment, where if it is a increase in the value, you will debit the asset, credit the pre-acquisition reserves. If it is a decrease in the asset's value, you will credit the asset and debit the pre-acquisition balance. Now the point over here is, after the acquisition, well, land, well, it does not really matter. Land of 500 continues to remain 500 because land does not get depreciated. But if it was building, then building would have gotten depreciated, which means, let's say the life of the building was, let's say 10 years, in which case if the WDV of the building on the acquisition date was 100, when the fair value was 500, well, at the end, 1 year later, this building would have appeared at 90, that is 100 minus 10 rupees ka depreciation, that would appear at 90. So this building would appear as 90, 10 rupees would have gone into the subsidiary's P&L in its calculation. However, if I am telling the world on the acquisition date that the building is worth 500, not 100, then my depreciation cannot be just 10. My depreciation has to be 500 divided by 10, that is 50. However, 10 is already charged, and hence you will have to pass an entry for an additional depreciation. So additional depreciation of 40, that will be for the period 25-26, which is after the acquisition, and hence this will affect the post-acquisition profit and loss, and the credit will go, for example, to the building. So when I look at the adjustments, there would be fair value adjustments pertaining to PP. I will say the initial adjustment, the difference between the fair value, let's say that is 500 minus the WDV, let's say that is 100, that is 400 on the date of acquisition. You will say PP account debit to pre-acquisition P&L. If it's an upward change, if it's a downward change, the entry will be opposite. PP will be affected in note 1, and then in working note 4 in the pre-column, you will impact the 400. But subsequent, there can be additional or there can be reversal of depreciation, like there was 40 worth of additional depreciation, that is for the period 25-26. It is a depreciation for the year 25-26 to the P.P.E. So if this was, for example, a building, this would have been, for example, 90. I would say that, okay, 90 plus 400 minus 40. 400 because the value is higher by 400, 40 less because the depreciation, additional depreciation should be incorporated, and hence this answer would have come to ultimately 450, and 450 is nothing but 500 minus 50, and that will give you the logical answer. The general rule, usually additional depreciation will be calculated as the difference between the depreciation based on fair value, that was 50, and based on WDV, that was 10, so that is 40 rupees. Now the general rule is initial changes in fair value will always go to the pre-reserves, as it reflects changes that have already happened till the acquisition date. Any subsequent changes, like, so initial changes will be adjusted against pre-reserves, as we saw over here. Any subsequent change like depreciation or sale would always be adjusted against the post-reserves. Why? Because this will impact the period after the acquisition date, since these events happen after the acquisition date. Again, we said name of the reserve does not matter. If you want, you can show a different name of a reserve, but it does not matter. Institute also does not do it, as the initial fair value adjustments would not affect the pre-acquisition profits, would be affecting the pre-acquisition profits, which are in any case eliminated In line with the ICAI solutions, we adjust the effects in the profit and loss or return earnings as the case may be. Now, there can be other items as well, like for example, inventory. Now, PP subsequently gets depreciated. Inventory subsequently can get sold. Achha, if there was inventory again which was worth 100 and whose fair value was 500, in which case initial recognition will still be the same, inventory account debit to pre-acquisition P&L, and hence your inventory will now, which in your SFS inventory was 100, that inventory will now be appearing at 500 in the CFS. Now, when I go to the next year, actually when you prepare the P&L, there is an opening stock, then there are purchases, then there is sales, and then there is closing stock. So, when I look at the opening stock, earlier let's say this was 100, you ultimately sold it at let's say 600. Let's say there were no further purchases, no closing stock, in which case the profit came to 500 rupees. However, when you this is in SFS. When you prepared CFS, your opening inventory in CFS was not 100, it was actually 500, sales remaining the same at 600. This profit would have been 100 rupees, and hence we say that if the inventory was subsequently sold, your SFS inventories COGS would be based on 100 rupees worth of stock which was appearing. However, in CFS, your COGS should be based on 500, and hence the effect will be that in subsequent, if the inventory is sold, remember, if the inventory remains unsold, your opening is 100, your closing is also 100, no effect on profit. Achha, you change this to 500, well, closing is also changed to 500, there is no effect in profit. So, if the inventory subsequently remains unsold, like land may, there was no depreciation, then there was no further adjustment needed after doing the initial adjustment. In a similar way, subsequently, if the inventory remains unsold, then there is no further adjustment needed. But if it is actually sold, then debit what comes in, credit what goes out. Inventory is going out, so inventory will be credited by, let us say, the fair value adjustment. Sir, inventory was already credited by 100, it should have been credited by 500, which is a fair value, and hence the additional 400 will be adjusted, and the second effect is your COGS will increase because of that. But COGS is the sale happening during the year 25-26, and hence the COGS. Long story short, again, for any fair value adjustments, if it is on the date of acquisition, you will adjust. If it is an increase in an asset, you will debit the asset, second effect goes to the pre-reserves. If it is a decrease in the asset, credit the asset, second effect goes to the pre-reserves. If it is a subsequent adjustment, then again debit what comes in, credit what goes out. If the asset is going out, you will credit the asset, you will debit the post reserves. Why? Because this is a change either due to depreciation or due to sale, which is after the date of acquisition. Easier working if nothing is, inventory remains unsold. We are lazy by definition. Why do you want to do additional adjustment? If nothing is going, you assume inventory is unsold. No further adjustment needed. Achha, there can also be a payable adjustment. In case of payables, what happens is on the date of acquisition, again, let's say there was a pending lawsuit. In the SFS of the subsidiary, they said that we believe that this will not be required to be paid. It is 50-50 chance, so they must have given a disclosure. But when you take over, in Ind AS 103, you will have to have a fair value. So, let's say there is a 50 rupees fair value, in which case you will have a payable which is created. So, payable will be created which is there on the date of acquisition, and hence the second effect will be against the pre-P&L. Now, later, let's say payable is still unpaid, in which case no further adjustment needed. But if the payable is actually paid, then payable in the CFS would be debited to bank. However, in the SFS, there is no payable, and hence you must have passed the entry P&L account debit to bank in the SFS. So, there must be a payment, but you would have debited the P&L in the CFS. Ideally, the entry should have been payable account debit to bank. Whereas to bank has already been created, and hence the rectification entry, if I go to see, would be you will debit the payables which were already created in your CFS, payables account debit, for example, to P&L which has been debited, which should not be debited in the CFS, and hence if you go to see, this is payable account debit to post P&L. This poses a bit of a problem for a lot of students. So, I again said for time and again, if there is a fair value adjustment, let it be for land, let it be for building, let it be for inventory, let it be for payables. You figure out whatever the changes up to the date of acquisition, those changes will be adjusted, second effect against pre-P&L. Whatever the changes after the date of acquisition, why will the change happen? If, for example, asset is depreciated, if let's say the inventory is sold, or if the payable is paid, in which case you figure out if payable is paid, payable should be debited, second effect in the post P&L. If inventory is sold, inventory is credited, second effect post P&L. If there is a depreciation and there is an additional depreciation, then asset is credited, second effect post P&L. You will need a bit of practice over here, but this is a broad understanding of these adjustments. Okay, next Another important adjustment I would say is your goodwill impairment. We would say that if there is a goodwill impairment, how will you account for it? Well, it depends on whether the goodwill is a full goodwill question or a partial goodwill question. So, if the goodwill is a partial goodwill, it is attributable to parent only, in which case the loss will be taken up by the parent only. So, your entry will be consolidated P&L account debit to goodwill. That's about it. So, if it is partial goodwill, consolidated P&L account debit to goodwill. However, if it is a full goodwill question, then the loss has to be shared by parent and N.C.I both. So, if there is a 100 rupee goodwill impairment, 70 rupees of that loss will go to the parent, 30 rupees will be borne by the N.C.I because it's a full goodwill. So, if goodwill is attributed to parent and N.C.I both, its impairment will also be eaten up by parent and N.C.I both. Consolidated P&L account debit, N.C.I account debit to goodwill. Unless given, this loss can be allocated in the ratio of the shareholding. That is what N.C.I does, and hence that is what we will also do. At this point, there may be a comparison that you might do along with impairment, Ind AS 36, where if there is a partial goodwill, there can be cases of grossing up. However, in most of the consolidation question, that complexity usually does not arise. That complexity only arises if you have to compare the carrying value with the recoverable value. In most questions, they directly give you the impairment amount, and if directly an impairment amount is given, let's say in partial goodwill questions, if they have told you that the impairment is 100 rupees, well, end of the story. If it is partial goodwill, goodwill has to be reduced by 100, second effect goes to the consolidated P&L account. And if it is a full goodwill question, if goodwill is to be impaired by 100, goodwill is to be reduced by 100, second effect goes to the consolidated P&L or the N.C.I. Like you can see over here, ultimately in your working note for goodwill last May, we have reduced impairment if any. In a similar way, full goodwill also, we have said, okay, 100 ka impairment we will reduce. However, one effect can also go to N.C.I's share of impairment. This will only come in case of N.C.I at fair value, full goodwill questions. Second effect can go into the consolidated other equity to the extent of your share. Again, we'll do sums based on this. Okay, so this is regarding goodwill impairment. Another important adjustment would be unrealized profit on intercompany transactions. This is parent selling goods to the subsidiary. Let's say the cost price of these goods are 100, selling price of these goods are 120, and the subsidiary is not able to sell it to an outsider, in which case for subsidiary the goods are appearing at 120. Now if I prepare the consolidated balance sheet, the inventory will be consolidated at 120 and the standalone profit of the parent will appear as 20. Now this is incorrect because this 20 in CFS level is a profit earned by transacting with your own self, and that has not yet been realized because subsidiary has not sold it to an outsider, and hence this 20 of profit needs to be eliminated. Acha, from where will it be eliminated? Well, this 20 is sitting in the profits of P. Profits of P are in working note 1. This is P&L account debit. For example, 2, you will have inventories. So your profit will fall by 20. This is parent's profit, inventory will also fall by 20. In a similar way, if it is upstream, the same thing applies, but subsidiary sells to the parent, in which case a profit of 20 is sitting in the subsidiary and the inventory of the parent appears at 120 rupees. The thing is the same, you will debit the P&L, but whose P&L? P&L of the subsidiary, but subsidiary's P&L has to be analyzed between pre and post. So you'll have to find the date when the sale happened. If the sale happened prior to date of acquisition, then this 20 will be adjusted against pre-profits. If it happened after the date of acquisition, it will be adjusted against post-profits. If nothing is given, institute always assumes that the sale happened post the acquisition, and hence you can adjust it against the post-profits. So P&L of the subsidiary account debit, for example, 20 to inventory, because the parent's inventory is overstated by 20 to inventory 20. Now this 20 has to be analyzed. We said if nothing is given, we will assume that this is post-profit, though if the question specifically tells you, we'll adjust it against the pre-profit as well. So P&L of the subsidiary account debit to inventory. Alternatively, remember P&L of the subsidiary is attributable to both parent and N.C.I. Consolidated P&L account debit, N.C.I account debit to inventory. So I can say that, let us say 20 rupees of the post profit. Let's say your total post profit was 100 rupees. We say 20 rupees out of that is attributable to this unrealized intercompany transaction, which means when you eliminate the 20, you are reducing 20 measures, 70% share is for the parent, 30% share is for the N.C.I, and hence effectively when you debit the P&L of the subsidiary by 20, 70% of that, that is 14 rupees, will effectively be reduced from the consolidated P&L, and 30% of that, let's say 6 rupees, will effectively be reduced from the N.C.I. So we have just clarified, if unrealized profit is in the books of the parent, you don't need to bifurcate between pre and post, but if it is in the books of the subsidiary, we need to allocate between pre and post based on date of sale. If the date of sale is not given, we assume it is post in line with the ICAI solutions. What happens for upstream is subsidiary selling to parent, downstream is parent selling to subsidiary. What happens for upstream or downstream, profits can also apply for losses. It is very much possible that an inventory of 100 is sold at a token value of 1 rupee, that is a 99 rupees loss booked by the parent. So subsidiary shows the inventory at 1 rupee and parent is showing a loss of 99, but for the group as a whole, 99 is not a loss, inventory is not worth 1, it is worth 100, and hence you will reverse the unrealized losses the same way you reverse the unrealized gains. Also, the upstream or downstream can happen in case of P.P.E, like there is a machinery of 100 you sell at 120. So parent has recorded a 20 rupee profit, subsidiary has recorded a machinery at 120. You will have to remove this 20 rupees of unrealized profit, but at the same time, subsidiary might have depreciated this machinery at 120. Let's say the life is 10 years. So 120 divided by 10, 12 rupees would have been the depreciation charged by the subsidiary in its SFS. Though for the group as a whole, the machinery is not worth 120, it is only worth 100, and hence the additional depreciation, if any, also needs to be reversed. So from where it will be reversed? Well, depreciation will be reversed in the books where it was charged. If the subsidiary is charged the additional depreciation 12 instead of 10, then the 2 rupees will be reversed in the books of subsidiary. If it was upstream, then subsidiary has sold at a profit to the parent, parent has charged depreciation, then the reversal will be in parent's books. In whose books profit is charged? Profit will be reversed in those books. In whose books additional depreciation is charged? Reversal will happen in those books. Okay. Next, you have uniform accounting policies. Now, usually when you do consolidation, consolidation should be based on like-to-like assets accounted using like-to-like policies. Now, if those policies are different, then you can't just blindly consolidate. You have to first restate. Acha, whose policies will be restated? Subsidiaries policies, to bring it in line with that of the parent. So, subsidiaries policies will be restated to bring it in line with that of the parent, and then you will prepare the consolidated balance sheet based on uniform accounting policies. Is restatement mandatory for different accounting policies? Yes. But that is if there's different accounting policies. If there's different accounting estimates, then restatement is not mandatory for estimates being different. Though if you want to restate, you can always restate. Though it is mandatory to restate for different accounting policies, it is not as mandatory to restate for different accounting estimates. Similarly, there can be different reporting dates, like your parent might have a 31st March 26 reporting date, but your subsidiary may have a 31st December 25 date, which means you cannot consolidate because there are different dates. Again, what you will have to do is you will have to restate the subsidiary's balance sheet at the parent's reporting date. So you will have to find the draft balance sheet of the subsidiary on 31st March 2027. So that means again you will have to do the entire finalization. Well, it depends. If the gap between the parent and the subsidiary's date is 3 months or less, then you can just do adjustments for material items. What are material items? Well, those will be items given in the question, like there may be a fire, so loss by fire, or there may be material asset purchases, sales, they will give you. You will make adjustments only for those material items if the gap is 3 months or less. But if the gap is more than 3 months, like for example, over here, the subsidiary's balance sheet was prepared on 30th of September 2025, which means the gap between parent and subsidiary is 6 months. Now there is no leeway. You will have to prepare the full balance sheet, considering all events, not just material events, and prepare the subsidiary's balance sheet on 31st March 2026, and only then can you prepare the consolidated balance sheet. So if the difference is less than or equal to 3 months, you will make adjustments for only material events. If it is more than 3 months, you will prepare detailed financial statements considering all the events. Again, in such questions, before you start the question, you will have to first prepare the balance sheet as per parents' policies, as per the parent's date, and only then will you start with the regular questions, though these adjustments are not as important. Then there is intercompany eliminations, like in the parent's books, subsidiary can be appearing as a debtor. In the subsidiary's books, parent can be appearing as a creditor, in which case you will eliminate them, because I can't be a creditor in my own books, I can't be a debtor receivable from my own self in my own books, and hence entry will be creditors account debit to debtors. This can also be for bills payable and bills receivable. You can eliminate the intercompany bills payable and bills receivable. You need to be mindful of the fact that if these bills were endorsed, then there is an actual liability. It will not be eliminated. Like for example, subsidiary had a payable to the parent. So parent ke books mein there will be bills receivable, subsidiary ke books mein there will be bills payable. However, the parent endorsed the bill or discounted the bill, in which case the subsidiary now has to pay to the endorsee or to the bank as the case may be, and hence there will be no elimination in case the bills have been, let's say, discounted or endorsed as the case may be. To that extent, for the bills which are still outstanding and held by both the parties, in which case there will be an elimination. Okay, there can be intercompany loans given and loans taken. Again, over here in the SFS, there will be loans, there may be interest. So, the loan along with interest, whatever is the balance, may appear as receivable in one of the books, loan along with interest will appear as payable in the other books. You will have to eliminate it. The important adjustment over here would be debentures and preference shares. Mainly, let us say if you focus on debentures, like debtors, creditors are not tradable items. So, if I have sold goods worth 100 rupees to you, there will be debtors worth 100 in my books, there will be creditors worth 100 in your books. End of story. It will be cleanly eliminated. Sometimes there may be adjustments like cash in transit, etc. if a payment is given but not yet received, but otherwise it's a clean adjustment. But when you look at debentures, it is possible that the subsidiary has issued debentures worth 100 rupees. But when the parent did not subscribe to those debentures initially, later the parent purchased those debentures from the market at 110. Now, these debentures are appearing as investments in the books of the parent at 110. These debentures are appearing as payable in the books of subsidiary at 100. Now, again, when I consolidate, this is intercompany and hence I'll need to eliminate. So, I'll have to eliminate. So, I will credit the investment. Investment is appearing at 110 and I will debit the debentures, liability, which is appearing at 100. In which case, there's a difference of 10 rupees. Where will this difference go? So, this is not an excess payment to acquire control. This is an excess payment to, in a way, settle a liability. A liability which was worth 100 is effectively getting settled by paying 110, and hence this 10 rupees is excess payment for settlement of a liability, and hence it will go to the P&L account. It will not impact the goodwill, because debentures and even under financial instruments 109 preference shares are largely treated as liabilities, and hence when you take this additional 10, this is payment towards a liability, and any excess payment toward a liability that will go to the P&L account. So, over here, when you look at debentures or redeemable preference shares, they are financial liabilities. They should be eliminated by preparing a note 1. Debentures are tradable. The purchaser of these debentures might have acquired them at a price which is different than that recorded by the issuer. Such elimination should be adjusted in the consolidated P&L. Now, again, it is not necessary that you have acquired all the debentures. It is possible that subsidiary had 100 worth of debentures. You acquired only debentures worth 55. These debentures had a face value of 50. Now, the remaining debentures are still continued to be paid. So, when you eliminate, you don't eliminate the entire 100 worth of debentures. You will eliminate the liability which is intercompany. Investment is 55, but that eliminates a liability worth 50, and hence 5 rupees will go to the consolidated P&L in working note number 1. In rare cases where the debentures or let's say preference shares are treated as equity, which is there's no sum like that, but if they are treated, then you treat it similar to that of equity shares, like you will take it as a part of purchase consideration along with your equity investment, and like the share in equity share capital you have to take a share in preference share capital. Though I would say this is relatively rare, you will usually have preference shares or debentures which are in the nature of liabilities. Okay, so this is regarding your intercompany preference share elimination. Then comes dividend. Now, this is again a very important adjustment, and this creates a lot of problem for a lot of students. So, you should remember general rules that you need to follow. Now, remember, dividend is appropriation of profit. I don't know, let's say I have reserves worth 500, out of which I can say 400 were earned pre-acquisition, 100 was earned after acquisition. Now, I pay a dividend of, let us say, 50 rupees. In my bank, if there are 500 and I cut a check of 50, my entry is dividend account debit to bank. I don't know that 50 is taken out of what? Out of the 100 of the current year or 400 out of the previous year? I don't know. Now, the general assumption is, to be safe, I can say dividend of a particular year is paid out of the profits of that year. And hence, if it is dividend for the current year after acquisition, it must be paid out of the profits of that year. However, if the question specifically tells you that the dividend is paid out of the opening balance or pre-acquisition profit, you have to respect that. Now, what are the adjustments that you need to do? Well, if dividend is paid out of post-acquisition profits, while you are preparing working note 4, you do in working note number 4, you do this working, that is, you will take, where is this? You will take the balance plus profit minus dividend. If it is paid out of the post-acquisition profits, you will just subtract it from the post-acquisition section. If it is paid out of the pre-acquisition profits, you will just subtract it from the pre-acquisition section. That's about it. Okay, sir, that's it. Now, the problem is, if it is paid out of the post profits, then there will be no further adjustment needed. Things will automatically nullify. How? That is difficult to grasp, but if I make an attempt, what will happen is, if the subsidiary has paid 100 rupees as dividend out of its post-acquisition profits, then, or let's say subsidiary has paid 50 rupees of dividend out of its post-acquisition profit, then I can say that, let's say 75 was a post-acquisition profit minus 50, and hence this will come to 25 rupees. Your profit is falling by 25. Now, you will take 70% of 25 will go to the parent, 30% of 25 will go to the NCI. So, what is going to the parent is relatively lower. However, when the parent would prepare its standalone profit and loss, when subsidiary has distributed dividend, that 50 ka 75% would have already received by the parent, and hence your standalone P&L is already higher. Now, one can say that this is an intercompany item. Dividend is paid by the subsidiary to the parent, yes, but the parent's profit is higher. Subsidiary's profit becomes lower. Actually, subsidiary earned 75, but I'm saying 50 is already paid. Okay, so remaining is 25. That 50 which was paid by the subsidiary to the parent is already a part of parent, and as a result, long story short, if dividend is paid out of post profits, there is no further adjustment needed, because the dividend paid by the subsidiary reduces the post profit of the subsidiary, but it increases the standalone profit of the parent, and both of them go in working note 1 only. This is lower because it is only 25 ke base pe. Let us say, for simplicity, if I were to take that this was a company where parent had nothing, so ideally parent's standalone P&L should have been 0. Let's say for simplicity there is 100% dividend, in which case the 75 rupees that was paid was appearing as dividend over here. But when I look at the share of the subsidiary's profit, 75 minus 75 will become 0. So I would say, okay, my total profit is 75, that is fine. For the group as a whole, parent ne kuch nahi kamaya, subsidiary ne 75 kamaya, that is still appearing total 75. The problem arises if the dividend is paid out of pre-acquisition profit. If it is paid out of pre-acquisition profit, parent as per Ind AS 109 would have still taken the dividend as an income in the P&L. So 75 would appear as a dividend in the P&L. Now, if it is paid out of pre-acquisition profit, then you will reduce that 75 from the pre-acquisition section. But the pre-acquisition profit does not go into working note 1. It goes into working note 2. So what happens is your goodwill is wrongly stated. Your goodwill will take your net worth after dividend being paid. So if, let us say, on the acquisition date your net worth was 400, out of which 75 is paid, you might say, acha, the net worth as on acquisition date is 400 minus 75, that is 325. No, as a matter of fact, the net worth was 400 only. By the way, out of that, a dividend was paid at a later date, but net worth was worth 400 only. So that 325 is not giving you correct net worth. Further, when I calculate the profits, your profits over here, there's an intercompany income of 75, but that is not getting offset by an intercompany expense from the post profit section, and hence there will be an adjusting entry which is needed. Long story short, it's a very difficult logic to grasp, but long story short, when you look at this, you will say that if there's a dividend, an NCI is calculated using the proportionate net assets method. If it is fair value method, slightly different. If the dividend is paid out of pre-profits, this is where it gets a little problematic. Deduct dividend from the pre-section. In working note 4, this is not a problem. Pre-section minus dividend, in post-section there is no change. But then, if dividend was out of post-profits, again same, deduct dividend from the post-section, then pre-section is no change, but post-section minus dividend aa jayega. Acha, if it is out of post-profits, there is no further additional adjusting entry needed. Why? Intercompany dividend income is offset by intercompany dividend expense. So these are offset. But when I look at pre-dividend, then my net worth calculation is wrong. My net worth is lower. It is only taking the net worth after the dividend. So I'll have to increase the pre-acquisition net worth. Further, my P&L of the parent, which was earlier, I was saying, chalo, intercompany income I have recorded will offset by intercompany expense. It is not getting offset. So the P&L of the parent will be debited. This will come in working note 1. So basically, I will debit working note 1 because my profit is overstated and it is not getting offset by an intercompany expense in working note 1, and my pre-acquisition net worth is getting understated, and hence consolidated P&L, or which is in working mode 1, P&L of the parent to pre-acquisition net worth. This will happen for the parent's share in the pre-acquisition dividend. Remember, this is partial goodwill, and hence we are working at only in working mode 2. You have only parent's share. In NCI, whatever was the due has been paid, and hence there is no further working adjustment to be done. However, if NCI is to be calculated using fair market value method, then what would happen is the fair market value on the acquisition date would become the dividend. That the dividend is paid later, so the fair market value which was on the acquisition date would become the dividend. The dividend is paid later, so that will reduce even the NCI. So if the dividend paid was, let's say, 100, out of which 70 is going to the parent, 30 is going to the NCI. In case of dividend using proportionate net assets method, you will pass the entry consolidated P&L account debit 70 to pre-acquisition net worth 70. That's it in my net worth. I'm just taking my share of the net worth, nothing else. But when it is NCI is at fair value method, my net worth will be 100% of the net worth. So my entry will be to pre-acquisition net worth, the entire 100 that will go. Debit consolidated P&L still by 70 because my intercompany income would have been recorded by 70 only, and my NCI, my initial fair value would have been come the dividend. I will have to reduce it. So my adjusting entry would be consolidated P&L account debit, NCI account debit to 100% of the net worth. If again dividend is out of post profits, there is no adjusting entry needed. This is a fairly important adjustment, I would say, regarding dividend. This is an entire rationale given, and a lot of students kind of face difficulty when they do the dividend adjustment. The long story short is, if dividend is out of post profits, there is no additional adjusting entry needed. You do the working in the usual manner. If it is out of pre profits, then there is an additional adjusting entry needed. If it is partial goodwill method, consolidated P&L account debit to your share in the pre-acquisition net worth. If it is full goodwill, then consolidated P&L account debit, NCI account debit to 100% of the net worth. Okay, then there is an adjustment for bonus. Institute study material per se does not have any separate adjustment for bonus, but if you see, a couple of exam questions have come where this bonus adjustment is there. There's no consistent treatment over here, but we can discuss what are the core principles. So when you look at bonus, in bonus adjustment, first thing you have to see is the number of shares. So sometimes what might happen is a question might say that we acquired 200 shares on 1st July 25. It will give a balance sheet of the company on 31st March 26, but this balance sheet might be having subsidiary share capital of the subsidiary, which is worth, for example, 300, but this may be post bonus. So you might have to calculate the stake properly. You can't compare 200 with 300. Now 200 ke baad, let's say on 1st October 25, there was a bonus. It may be a 1:10 bonus, for example. So there might be a bonus. So I can't compare 200, which is pre-bonus, with 300, which is post-bonus. You have to compare correctly pre-bonus number of shares acquired with the pre-bonus share capital prevailing then, or the post-bonus shares acquired with the post-bonus share capital. And as a result, over here, it has to be a like-to-like comparison. Secondly, if there's a dividend along with the question where there's a bonus, you have to find the date when the dividend is paid. If the dividend was paid prior to the date of bonus, then it will be only on the shares, for example 200. But if the dividend is paid after the date of bonus, let's say there's a 1:10 bonus, which means 200 shares will get 20 shares as bonus, and if the dividend is paid after the date of bonus, then the dividend will be on 220 shares. So you'll have to look at the date of the dividend carefully and compare it with the date of bonus. If it is given on if the dividend is given after the date of bonus, in which case you will pay dividend on the post bonus number of shares. If it is given before the date of bonus, you will give dividend on the pre-bonus number of shares. Now, like dividend, we were saying that if nothing is given, dividend for a year will be based out of the profits of that year. Bonus, on the other hand, is usually capitalization of profits, and usually the oldest profits you will assume are capitalized first. So over here, bonus is capitalization of the reserves. Unless given, we assume that the oldest profits are to be capitalized first, and hence if nothing is given, bonus is out of pre-reserves. Now, the problem arises in accounting for the bonus as a part of a bigger question. Now, there are two alternative treatments. Both will ultimately achieve the same objective. One of them is if the entry for bonus is passed. What is the entry for bonus? Reserves account debit to share capital. We have said that if nothing is given, we take out of pre-reserves, though it can also be out of post-reserves if the data tells you that. We'll say, how does it matter? Ultimately, reserves belong to whom? Sir, shareholders. Share capital belongs to whom? Sir, shareholders. In any case, bonus is a book entry, and hence what one can do is one can just reverse the entry for the bonus which was passed, and you can just say that this is just a book entry and reverse the entry for the bonus, in which case you will debit the share capital, credit the reserves, so that you can find the reserves exactly which were there as on the date of acquisition, and the share capital which was also there on the date of acquisition. Why? Because if your share capital, for example was 1000 and there was a 1:1 bonus, that means currently the share capital is appearing as 2000. So when you sit to calculate the net worth on the acquisition date, you will take, okay, the share capital is 2000, but it was never 2000 as on the acquisition date. It was 1000 then, and hence you try to reverse the effect of the bonus in the share capital, and second effect will be reverse the effect of the reserves as well. If you are able to do that, that is, if the entry for bonus is passed and you reverse the entry for bonus, that's it. Then there is no further change. That means you have ignored the bonus altogether, and then there will be no further change in the entire solution. You will just take the adjusted balance of the reserves and the adjusted balance of the share capital, and everything falls in place. In my opinion, that is a much more easier and simpler way. Institute usually uses this when the question tells you that there was a bonus and the subsidiary has not yet passed entry for the bonus. Then what could have been done is you first pass the entry for a bonus, then show the reversal. Usse acha you don't pass the entry only. That is what Institute does. Instead of passing the entry and then showing the reversal, they don't pass the entry only. They don't even need to show the reversal. Alternatively, the entry for bonus is already passed, then you have to pass a separate entry to reverse the bonus, take the adjusted balances and do the work. Achha, what is another method? Well, another method over here, like you did for dividend, you said that, well, if bonus is out of pre-acquisition profits, remember pre-acquisition reserves go into working mode 2. Share capital also goes into working mode 2. So if bonus is out of pre-acquisition reserves, even if you don't pass an entry to reverse the bonus, you say, bhai, theek hai, your share capital is higher, but share capital is going in working mode 2. Your pre-acquisition reserves are lower because of the bonus giving out of pre-acquisition reserves, but that is also going in working mode 2, so the effect will nullify. But if the bonus is out of post-acquisition reserves, then your share capital is higher, which is going in working mode 2, and your post-acquisition reserves are lower, the effect of it is going in working mode 1, and hence an adjusting entry is needed in such a case. Though if I were to solve a paper, I would say that I will reverse the effect for bonus. If the entry of bonus was already passed, I will reverse the effect and do the working. That is a much more easier way to do. So bonus is merely a book entry, and hence a reversal entry can be passed. Share capital account debit to reserves. Alternative 1, if bonus entry is already passed and no reversal is to be done, then if bonus is out of pre-profits, deduct bonus in the usual manner from pre-profits and then no adjusting entry needed. If bonus is out of post-profits, then deduct bonus from the post-profits and then an adjusting entry is needed, where I will reduce my share in the net worth. Kyun? Because equity share capital was higher. I now have to reduce that and credit the consolidated P&L because the post-acquisition reserves have been lower. Bonus is just an appropriation, it is not an expense. More easier would be, I would prefer alternative 2, where I reverse the entry for bonus altogether initially, that is share capital account debit to profits. After this, no separate adjustment is needed since we are doing workings based on adjusted pre-bonus balances only. Okay, so this is pertaining bonus. What ICAI is used, both methods in the exam. If no effect for bonus is given in the question, it is easier to ignore the bonus and solve it directly. That is what I personally prefer. If I were to solve, I would prefer using alternative 2, though both alternatives are possible. Okay, then there is additional stake purchase. If there is an additional stake purchase which results in acquisition of control, like for example, you had a 40% stake and now you are acquiring another 30% stake. Now this will make it 70%, and hence this 30% stake results in acquisition of control. If this is a stake which is resulting in acquisition of control, then Ind AS 103 will acquire. And if you remember Ind AS 103, what it says is you will remeasure the existing investment, that is 40% to fair value. Then you will take over all the assets and liabilities. You will create N.C.I, you will create goodwill, as a case may be. This is a clear Ind AS 103 adjustment. Or there can be additional stake purchase after control is there. Like for example, you had a 60% stake and then you are acquiring another 30% stake, which gives you 90%. Now this is an acquisition of stake after control is acquired. Now how will I account for this in my CFS? Can I show it as a purchase of investment? Answer is no. Why? Because with a 60% stake, you are already consolidating, which means you can't show an investment in your own self, and hence investment cannot be debited. Achha, so can I debit the net assets? Answer is no. Why no? Because you have already consolidated 100% of the net assets. If you acquire 30% more, you cannot consolidate 30% more assets. Then what will you debit? Sir, I will treat it as a purchase of N.C.I. transaction. I will treat it as if my N.C.I. which was earlier 60 and 100, so N.C.I. was 40. If I am purchasing 30%, that means my N.C.I. remaining is only 10%. So I will treat it as a purchase of N.C.I. transaction. I will debit my N.C.I. So N.C.I. account debit to bank. Now let us say your N.C.I. was, for example, in your books 400 rupees for a 40% stake. So for a 30% stake, it will be 300 to bank. For example, you have agreed to pay 350 rupees, which means there's a 50 rupees extra. Now, where will that go? Well, the question is, will it impact the goodwill? The answer is no. Why? Because goodwill arises on the acquisition date only, and acquisition date was a date when 60% was acquired. After that, when 30% is acquired, that is not the date of acquisition of control, and as a result, you cannot create a further goodwill. So goodwill, if initially was recorded using partial goodwill method, then goodwill will continue at the partial 60%. It was recorded using full goodwill method, then will continue to remain at full. But for the 30%, I cannot adjust the goodwill further. Okay, that is point number one. Point number two, okay, if not goodwill, I will say that this is a loss, I will take it to the P&L. Well, you can take it to the P&L if it is a transaction with an outsider. So if there was a liability for which I have to pay less amount, like a debenture for which I have to pay less, or I have paid more, I will take it to the P&L. But this is like a N.C.I. is a part of owners. It is like a retirement of a partner. And when partners retire, if there is a gain or loss on retirement, I don't let it affect the partnership profit and loss account. It is adjusted against the capital accounts of the other partners. What I'm trying to say is, this is an owner to owner transaction, and I cannot make a profit by transacting with my own self between owners. I have to make a profit, I have to transact with outsiders, and hence N.C.I. is not an outsider, it is an owner, it is a part of equity, and hence the balance over here will be adjusted against other equity. It will be directly against other equity. Like when there's a retirement of a partner, I would adjust the accounts of the existing partners, and hence your other equity will be debited over here, for example, by 50 rupees. Okay, so remeasure, if additional stake gives control, you remeasure the existing stake at fair value, take over the net assets, create goodwill, and N.C.I. eliminate existing investment. This is Ind AS 103. But if it is after control is acquired, this is where 110 angle comes. Then you will treat it as a purchase of N.C.I. No additional net assets to be taken over. Proportionate N.C.I. on the date of acquisition to be debited. Like if there was 400 for 40%, then for 30% will be 300. You will debit it, and N.C.I. are treated as owners, that is equity, and hence any gain or loss will be adjusted against other equity, and you will not let it impact the statement of P&L account. So N.C.I. account debit, loss on purchase of N.C.I. account debit, this will go against the other equity, and that will be it. After you do stake purchase, then there will be an adjustment pertaining to stake sale. Again, the working remains the same, that what happens if there is a stake sale which does not result in a loss of control. Like for example, earlier you had a 90% stake, and now you are selling, for example, a 30% stake, which means you are still left with a 60% stake. That means you still have control, which means in my CFS, how will I account for it? Well, I can't show it as a sale of investment because, well, I'm not showing investment in my books. I'm showing assets and liabilities. Achha, so let us show it as a sale of asset and liability. Again, I cannot show that because even if I had a 90% stake or if I had a 60% stake, I'm going to show 100% of my assets and liabilities only. Which means, how will I treat this? Well, I treat it as a creation of N.C.I. That means the 10% N.C.I. which is already there, I'll keep it as it is. There will be a further 30% N.C.I. that will get created, and hence the entry over here will be N.C.I. will be credited. Bank will be debited. By, because when I sell this, I will get money. So my entry will be bank account debit, for example 350 to N.C.I. When I create this N.C.I., there is a bit of a problem. What will I take? Well, I will take my net assets as on the date. Let's say this is 1000 into 30% that is getting created. Okay, so that should be 300. Perfect. However, remember, there may be a goodwill which was earlier calculated, whether you follow full goodwill method or whether you follow partial goodwill method. Let us say there must be a goodwill of 90 rupees which was created under the partial goodwill method. When you sell 30% stake, you don't de-recognize 30 rupees worth of goodwill. You say goodwill was created as on the acquisition date, it will continue to remain at 90 only, which means if the parent does not have 90, by the way, out of that, 60 rupees is still held by the parent, 30 is now held by the new NCI. The old NCI of 10 does not have any share in the goodwill, but the new NCI will now have a share in the goodwill, and as a result, I just cannot take 1000. I will have to take 1000 into 30%, yes, but 90 is for 90%, then for 30% also I will have to take. So when I calculate, I will take the net assets on the date of sale plus the goodwill into the stake sold, that is 30%. I will simplistically, Institute does it simplified, mathematically it can be slightly different, but Institute on a simplistical base says that, well, 1000 plus, let's say 90 into 30%, though mathematically the most accurate way would be 1000 into 30%, yes, but 1000 was 100% of the assets. 90 rupees is for 90% of the goodwill. So if 90 is for 90%, then for 30% it will be how much? That is the more accurate way that you should be doing. But for Institute has only one problem, and it has done it on a direct simplified manner, in which case if I go to see, this will be your NCI. And the balancing figure again over here, this is like admission of a partner. Like if there's an admission of our partner, and again if there's a difference, the difference will be adjusted against the capital accounts of the partners. You will not let it go into the P&L. So this will not impact the goodwill, it will not impact let us say the P&L, it will again go against other equities. So this will be either a gain or a loss, as the case may be, on creation of NCI. So if there's no loss of control, you treat it as a creation of NCI transaction, bank account debit, gain on creation of NCI to NCI, as the case may be. We have explained the logic as well, that why will I take this as including goodwill, because goodwill was created on the acquisition date for the entire stake acquired, let's say 90%. It's a different example. When there's a stake sale, say 20%, we do not derecognize 20% of the goodwill, and hence a corresponding share of the goodwill should now be allocated to the NCI. So this is the logic. But sir, what if there is a loss of control? If there's a loss of control, like for example, you had a 90% stake and you are selling, for example, 60%, which means you're left with 30%, in which case, well, this will be treated as a sale of asset transaction. This is not a creation of NCI. Now, you're not creating NCI. You yourself are NCI, by the way. And as a result, this is treated as a sale of asset transaction. You will derecognize the net assets. You will derecognize the goodwill which was there in your books. You will derecognize the NCI. So you will remove everything which was there due to consolidation. Okay, so you will remove the net assets, 100% of them. You will remove the NCI. Earlier, I think there was 10% NCI, so you will remove that. And goodwill, if any, partial, full, whatever it is, you will remove that. So all of that will be removed. In return, what are you getting? Well, in return, you are getting consideration. But remember that consideration is only for the 60% stake. So bank account debit, whatever is the consideration for the 60% stake, you will write to net assets, to goodwill. You will also debit the NCI. So, but is there anything else? Well, yes. Now investment will have to be created. Till now, you did not have any investment, because you were saying that, well, I was controlling the entity, and hence instead of showing the investment, you were showing the assets and liabilities. However, now you have lost control, but you still retain a 30% investment, and hence that investment has to be brought in. So over here, if there is a loss of control, all net assets of the subsidiary, all along with the goodwill, NCI should be removed from the consolidated books. Further, in case some stake is retained, investment should be created. And gain or loss, gain or loss will go where? Sir, it will go in the P&L. Why? Because this is not a creation of NCI transaction, it is a sale of asset transaction. And if it is a sale of asset, it will be taken directly to the profit and loss. So over here, should be taken to the P&L, as it is treated as a disposal of the net asset transaction. So when we are looking at this case, you will have investments. So over here, when we are looking at this, we will say bank account debit with whatever is the sale proceeds for the 60% stake. NCI account debit in my books 10%, whatever of the net assets etc. was there, I will remove, and I will bring in investment. Now, at what value will I bring in investment? Like when I had control or I acquired control, I created NCI either using fair value method or using the proportionate net assets method. The same logic will apply. When I lose control, I will create the investment either using proportionate net assets method or using the fair market value method, depending on the data given. If the question has given you data regarding fair market value, you will take that. Otherwise, you will take proportionate net assets. To net assets, remove the goodwill, and to gain on sale, and this will go to the P&L account. You remember over here that how will you calculate the investment balance? Well, if it is calculated using proportionate net assets method, you will find the weight that this subsidiary had in my balance sheet, that is net assets plus goodwill minus NCI. This as a debit balance. This has a debit balance, this has a credit balance. So this will give you the carrying value. This is a carrying value for 90% stake. So you'll say for 90% just a day before, you were showing at what balance? That means a day later, I don't have 90%, but I still have 30%. It will be worth how much? So NCI would be based on net assets, excluding goodwill in partial goodwill cases, and based on net assets including goodwill in full goodwill cases. That is fine. This is regarding NCI. If I want to find investment retained can be valued at fair market value. If you have been given 30% of fair market value, directly take that, or proportionate carrying value of the stake retained on the date of stake sale. Now, stake retained, you will find the carrying value for the 90% stake and proportionately find what will be the value of the 30%. Unless given, we will follow the proportionate carrying value method. Okay, that is regarding stake sale. Again, a special case in the case of a stake sale might happen that if you are entering into multiple transactions at almost the same point on time, if they are a part of a single larger transaction, then the Ind AS says you will treat it as a part of a single transaction. And accordingly, so if you are selling a 25% stake and immediately in 1 month selling a 55% stake, so 25 and 55 you are selling effectively 80, but then you will not treat them as separately. 25 that is creating maybe N.C.I, 55 loss of control. No, you will treat it as a single sale of 80% only, and there is a sum for that also separately, but it is not as important a concept. Okay, then you have something called as parallel subsidiaries. Now, when you look at parallel subsidiaries, what happens is there is a single company P which has multiple subsidiaries. Over here, the only thing that you will do is you will find the P stake and N.C.I in each of these companies, do the workings goodwill N.C.I in a columnar format for each of the subsidiary, and analyze the retained earnings separately for each of them, because they might have a different date of acquisition, they might have a separate parent and N.C.I stake. It is a very easy thing. It is just that it is two questions. If there are two subsidiaries, you have to analyze for one subsidiary, then analyze for another subsidiary. You can do it in a columnar form as well. So there's nothing difficult, honestly, when it comes to parallel subsidiaries. Now, another important adjustment, this is the last of those important adjustments, will be something with this chain holding, which is also one of Institute's favorite adjustments. So when we look at chain holding, what is the difference between chain holding and a parallel subsidiary? In parallel subsidiary, P has itself control over S1, S2, S3. But when you look at chain holding, P has control over S1, S1 has control over S2. Now, P might be holding an 80% stake in S1 and hence P will consolidate S1. S1 has a 60% stake in S2 and hence S1 will consolidate S2. However, if they are asking a consolidated financial statements of P, well, will P consolidate S2 is the question. Well, if I find the effective stake, that is 80 into 60 will come to, let us say, 48%. However, that is not how control works. Control works based on the entity's ability to direct the relevant activities. Now, if there is a general meeting of S2 which is called, S1 gets a right to vote for 60%. And how will S1 vote? P can direct S1 to vote for the entire 60% in a manner that P decides, and hence even over here we can say that P has control, and thereby P will consolidate S1. P will also consolidate S2. So both of these will be consolidated along with P. So this is assessment of control where there can be a direct control. So P directly controls S1. There can also be indirect control where P indirectly controls, for example, S2. Okay. Now when I look at N.C.I over here, N.C.I can get a little interesting. Now P has 80% in S1 and hence 20% of P. 20% of S1 is held by the N.C.I. But when I look at S2, one can always argue and say, okay, S2 has 60% held by S1, which means N.C.I will be 40%, but that is not entirely correct. That is correct if I am preparing CFS for S1, I am preparing CFS for P, and when I am preparing CFS for P, I will say how much percentage of the net assets are attributable to outsiders. So over here, if S1 has net assets worth, for example, 100, it can distribute everything. So 60 will flow to S1, 40 will flow to the N.C.I. When S1 distributes everything, 80% of this 60, that is 48, will reach P. 12 will further be leaked to an outsider, and hence 40 plus 12, that is 52 of your net assets of S2 will be going to the outsiders, which means only 48 will reach P. So if I want to calculate N.C.I, the best way to calculate N.C.I is 100 minus P's effective stake. So if P's effective stake, for example, was 48%, 100 minus 48% will come to 52. Alternatively, you can also calculate it, that is the direct share of N.C.I, we can say is 40%. Further, indirectly, we can say that, well, out of this 60, 12 will, that is 20% of 60 will go to an outsider. So 60 into 20% will come to 12%, and hence total comes to 52. So there are two things. First, you will have to figure out whether P controls S2. If it does, you will have to figure out the NCI. NCI is 100 minus P's effective stake. P's effective stake is 80% into 60%, that is equal to 48%. 48% of whatever S2 distributes will reach P. That means the remaining 52 will be lost somewhere, and that will be to an outsider, and hence that is NCI. Now, there can also be a case where P also, apart from this, holds a 10% stake, in which case I would say P's stake in S2 is a direct 10% stake and an indirect 80 into 60, that is a 48% stake, and hence totally P will get 58% of the net assets. Therefore, NCI would be 100 minus 58, so that is equal to 42%. Okay, now there can also be a question on figuring out what the acquisition date would be in chain holding. Acquisition date is a date when P acquires control. Like for example, if P has in 2010 80% over here and S1 is in 2012, then I will say that the date of acquisition is the later of those dates. P gets control in S2 only after S1 gets control in S2, and hence 2012. The other way around, P has 80% in 2012. S1 already has 60% since 2010, but P cannot control S2 till the time P controls S1, and hence 2012. Now, a student might end up thinking that that means later of the two. Well, that is not necessary. Like even over here, this is 80, this is 45. Now, with 45 at 2012, I don't have control. I can order S1 to vote in a manner I want for a 45% stake. However, well, I get 10% in 2014, which means this is when I get effectively 45 and 10, that is 55%, and hence the date of acquisition is 2014. In all the three above, we have said later of the dates, but that is not always the case. Like when you look at the fourth case, you will have 80, 60, and then another 10 is 2014. But even without this 10, I would say that with a 60% stake over here, there is a control, and hence 2012 will be the date of acquisition. Sir, why is it so important to determine the date of acquisition? Because your pre and post depends on the date of acquisition only. So first you assess whether P has control over the chain of the subsidiary. Second, you figure out what is the NCI percentage stake, and third, you figure out the acquisition date. Fourth and the most important point over here is what are the differences when it comes to accounting? Well, when it comes to accounting, your step 1 would be preparing the balance sheet, no problem. Step 2 will be note on assets and liabilities. You'll have P, S1, S2, all of them, no change in that. Then you can probably determine the NCI as well, percentage, that 48% or 42% or 52% as the case may be. And then when you go to working note 1, again you will have to consolidate. Okay, so we want to figure out the changes in the consolidation process. As we said, the steps for balance sheet, notes to accounts, consolidated profits will remain the same. But when we go to the goodwill workings, in the goodwill workings, well, P has control over S1, so there will be a goodwill on that. P has also control over S2, so there will be a goodwill on that. Now, how do you calculate goodwill? You will compare the investment with the share in the net assets. If it is partial goodwill, you will compare investment plus NCI minus 100% of the net assets or net worth if it is full goodwill. Now, when I look at the investment, we eliminate the investment. Usually, when I look at investment over here, if we make the balance sheets, in the balance sheet there will be P, S1, S2, again there will be P, S1, S2. Now when I look at investment in S1, this will appear in P's balance sheet. Okay, now against that you will eliminate the equity share capital which is in S1's book. So I will say that this is investment appearing in P's balance sheet. That will give me access to the share capital as well as the reserves, P&L as a case may be, which is appearing in the books of S1. Perfect. So when I eliminate this investment is in P's books, and 100% of the assets and liabilities of P's books are attributable to P only. Okay, that is easy. But when I look at investment in S2, investment in S2 will appear in the books of S1. Now, this, by virtue of this investment in S2, I will get access to the share capital and the profit and loss which is there in S2's books. I'll again repeat, this is investment in S2 which will appear in S1's balance sheet. When we are looking at this investment which is appearing in S1's balance sheet, if I eliminate this investment, remember all assets, all liabilities of S1 are attributable to the parent and to the NCI. Sir, but in what ratio? Well, all assets and liabilities of S1 are attributable in the ratio of 80:20, for example. So when you eliminate this investment, I would say against the cost of control, you will have 80%, 20% will be going to the N.C.I. Whereas when you look at the share capital and reserves of S2, they are appearing in S2's books, and in S2's books, parent has effectively 48 and N.C.I. is effectively 52. Now this is where the problem arises. When you will do the sum and you will sit to calculate the goodwill, you will say, acha, investment in S2. You will say investment in S2, everything of S2 has to be 48, 52. No, it may be investment in S2, but it is appearing in S1's books, and all assets and liabilities in S1's books are in the ratio of 80-20. Whereas share capital and reserves of S2 are appearing in S2's books only, and hence this will be in the ratio of 48, 52 or as the case may be, because they are appearing in S2's books. So when I'm looking at elimination of investment, this is where the problem arises. The investment made by S1 in S2 is a part of S1's balance sheet. All assets appearing in S1's balance sheet are attributable to P 80, N.C.I. 20. Hence, elimination of investment cannot be fully done through the goodwill workings because it is in S1's balance sheet. Till now, all concepts, adjustments had investments appearing in P's balance sheet only. Now the investment is in S1's balance sheet, and once you eliminate it, you'll have to give it in the ratio of P and N.C.I. for S1. Okay, so that is what you have to be careful, specifically in chain holding. Almost every time that chain holding has come in the exam, it has come with N.C.I. at fair value. So students come to that incorrect conclusion that because it is chain holding, we are doing those steps. No, we are doing the steps of PC plus N.C.I. minus 100% of net assets because it is investment at because it is N.C.I. at fair value. Now, whether it is chain holding or no chain holding, it does not really matter. Your solutions would still remain the same. Okay, next you have investment in subsidiaries. If it is shown at fair value in the SFS, if you remember Ind AS 109, that shows investments. There's also another standard called as Ind AS 27, which is on SFS. Now, Ind AS 27 says that investments in subsidiaries, joint ventures or associates can either be shown at cost or they can be shown using Ind AS 109, that is at fair value. All the sums that are there in the material, almost all of them have an assumption that investments are going to be shown at cost only in the SFS, which means that amount is the same as the purchase consideration. So maybe you have paid 100 rupees to acquire a 70% stake. Your investment will continue to be appearing at 100 rupees only in the SFS of P, because that is going to be at 100 rupees for a 70% stake. Now, secondly, when I go to see over here, there can be investments at fair value. So this 100 you can remeasure in the SFS and show it at 120, and the 20 of gain can either go to P&L if it is FVTPL or OCI, fair value reserve, if it is FVOCI, which means the investment in the balance sheet will appear at 120. 20 rupees has gone to the P&L of the parent or OCI of the parent as a case maybe. However, 120 is not the PC. When you calculate the goodwill, you cannot take 120, and hence you will have to reverse this fair value adjustment. So you will say, for example, P&L or OCI as a case may be account debit to, let us say, investment that is 20, and as a result, this 20 we would take into our calculation, bring down the investment back to 100 and then do the working in the usual manner. So over here, if the investment is at fair value, pass an adjusting entry to reverse the fair value gain. This is P&L or OCI account debit to investment. After that, the solution kind of remains the same. So these are the top 12-13 adjustments as a case maybe if it is pertaining to subsidiaries and consolidation in case of subsidiaries. There is also another thing over here, which is an exemption from preparing CFS. So there are two cases in which you can be exempted from preparing CFS. First is a group structure, like there is P ke niche there is S, S ke niche there can be S1, S2, then there can be a big structure per se. Over here, P is the ultimate company, S is the intermediate company. If I go to see over here, S3, S4, all these companies, like when I look at S, S1 and S2, all of these are intermediate companies. This is the ultimate holding company. S3, S4 are the ultimate subsidiaries. Now, when I look at S, S1, S2, these are the intermediate. These are the intermediate holding companies. So when I look at these intermediate holding companies, there is an exemption that is provided, because if I have to look at S1 and S3 has to prepare a CFS, S2 with S4 has to prepare a CFS, S with S1, S2, S3, S4 has to prepare a CFS. However, there is an exemption given. When will the exemption work? If the ultimate holding company is preparing consolidated financial statements as per Ind AS. Okay, that is point number 1. That is when you can possibly claim an exemption for intermediate companies. Also, none of these this intermediate company which wants to claim an exemption, none of its securities are listed. So for example, if S1 has any of its securities like debentures or equity shares which are listed, then this exemption cannot be claimed. The intermediate company which is claiming the exemption should not have any securities which are listed, and it should be a part of the group where the ultimate holding company is preparing accounts as per Ind AS. Like if the ultimate holding company is a foreign company, it will not prepare accounts as per Ind AS, in which case the exemption based on P will not be available. Then you will have to see, if P is a foreign company, then you will have to see S. If S is an Indian company, I would say, okay, if is S preparing its accounts as per Ind AS, yes. And is S1 having any of its shares which are listed, vagara? No. In which case S1 can claim exemption from preparing CFS provided, well, if it is a wholly owned subsidiary, then I don't need to have intimation or confirmation from anyone. If S does not want S1 to prepare, it will not prepare. It's a 100% owned subsidiary. However, if it is partly owned, for example, if it is 80% owned by S1, 20% is held by someone else, then S1 will have to give an intimation to the 20% shareholders, and if none of these shareholders raise an objection, then they can be exempted from preparing CFS. But if even one shareholder out of these 20% raises an objection, then S1 will have to prepare CFS. So an intermediate company is exempted from preparing CFS if its ultimate controlling entity wants to claim such an exemption. Ultimate controlling entity will be the entity which is preparing its CFS as per Ind AS. Exemption, if there is a wholly owned subsidiary, well, we will say there is no other shareholders preparing CFS for intermediate company can be exempted if the ultimate company decides to claim such an exemption. No other intimation needs to be given. Okay. And then if it is a partly owned subsidiary, exemption can be claimed if the ultimate controlling entity wants to claim such an exemption. However, if it is partly owned, then you need to inform this to the other shareholders, and there should be no objection in the preparation of the CFS. Okay, so over here, there are a few other conditions. The ultimate controlling entity prepares CFS for public use as per Ind AS. Foreign companies cannot be treated as ultimate holding companies, and the equity and debt instruments of the intermediate companies are not listed. Remember, the ultimate control needs to be checked with respect to a controlling entity, not an individual. So at the top, whoever is the top company who is preparing as per Ind AS, that is treated as the ultimate holding entity, not a person or an individual. Okay, and then exemption for non-preparation of CFS is available to an investment entity. An investment entity, loosely speaking, is something like a venture capital fund, mutual fund, private equity fund, where what I do is I invest in so many different companies. My main objective as an investment entity is to provide investment management services, and the return that I earn is largely in the form of investment return like a dividend and capital appreciation, and I track my performance using fair value gains. Now, if I'm a venture capital fund or a private equity fund, maybe the startup is losing money, they are making losses. However, if the valuation is doubling, for me the fair value is most important. So when I look at most of these investment entities, they meet 3 criteria. First, they obtain funds from investors for providing investment management services. Second, commits that the objective is solely for earnings return from capital appreciation or investment income or both. And third, measures and evaluates the performance of all of its investments on a fair value basis. These are the 3 top criteria that are going to be looked at, and because you're evaluating the returns on a fair value basis, it makes sense for you to show these investments in the subsidiaries at fair value through profit and loss principles. It is FVTPL. Okay, so there are a few other criteria for investment entities as well, like usually like a mutual fund, etc. They will have more than one investors, they will have more than one companies in which they are investing. None of these are related to each other, and you are taking ownership interest. Most of these funds do have a like a life. There is an exit strategy where they will exit after 5 to 7 to 9 years, for example. So there will be an exit strategy in place for equity. For debt, largely you don't need an exit strategy because debt will automatically mature, but there would be exit strategy in place for the equity investments. Now when you look at parent entities, if the parent entity is an investment entity like a mutual fund, it might have 10 companies over which it has control. It does not need to consolidate these 10 portfolio companies. It can show these investments at FVTPL even in the CFS. However, if there's a mutual fund or a venture capital fund which is acquiring another mutual fund or venture capital fund, in which case you are acquiring an investment entity is acquiring another investment entity, that is a business acquisition and not just a financial investment, in which case full consolidation principles can apply. So in case a parent is classified as an investment entity, it can show its investments as per FVTPL principles even in the CFS. That is, line by line consolidation is not required even if the parent owns more than 50% stake. Like you have this play school or preschool or a school under the name of EuroKids. KKR, which is a private equity fund, has more than 90% stake in that company. Now for KKR, it is one of the many portfolio companies. I don't have to consolidate the assets, liabilities of the school into KKR's balance sheet. KKR is a private equity fund. Now this is, let us say, a exemption which is available only for investment entities. This is done because the owners of investment entity are more interested in the fair value of the investments rather than the individual assets and liabilities. The only exception over here is if you were to acquire investment through another business acquisition, then you can do full consolidation. Now that largely takes care of consolidation of the subsidiaries. If you also want to do consolidation of joint ventures and associates, I have a separate video for this, for which I will share the link in the description as well as on the top over here, so you can probably refer that if you also want to cover joint ventures and associates. But this largely takes care probably in less than 2 hours regarding the entire conceptual flow, including steps, processes, adjustments for consolidation. But more importantly, we should also apply that. So we will do the sums, the important sums. I will take initially the sums that are there in our Super 149 file. These are the top 4 sums we should review, and then if time permits, we can discuss a few other sums as well. But these are the top sums where we kind of strengthen the process flow, etc. Okay, so I'll just share that on the Telegram channel as well. But otherwise, if you have this handy, even if you have it in your book, I think in most of the books this will be question number 10, 11, 12. I think 10, 11, I'm not sure, 12, 11 or 12, and then there is question 18 on chain holding, and there is a question 40 for which we have a separate video as well. Okay, so let us go on into the questions. Okay, so let us go to the top questions that we have. There's this question, I think this is question number 11 of your books. This is question number 1. It's a multiple time exam question. This Ram acquired 60% of ordinary shares of 100 each of Krishan on 1st October 11. On 31st March 12, the balance sheets were as follows. So you have been given the entire balance sheet. Notable items over here is the investment in Krishan, which is at 8 lakh rupees. This is for a 60% stake. The retained earnings of Krishan showed a credited balance of 60,000 on 1st April 11. Remember, the date of acquisition is 1st of October 11, and you have been given retained earnings on 1st April 11. This is 6 months earlier, and hence this is prior to the date of acquisition, out of which a dividend of 10% was paid on 1st November. Now, dividend may be paid on 1st November, but it is paid out of the retained earnings on 1st April 11. 10% dividend unless given otherwise. Dividend is a percentage of face value, and as a result, we will take 4 lakhs into 10%. I can say 40,000 must be the dividend. It is paid out of the retained earnings on 1st April 11. It is paid on 1st November. This is first adjustment. So this is dividend out of pre-acquisition profits. This is pre-acquisition dividend. Ram has credited the dividend received to its retained earnings. Okay, so the receiver, that is Ram, would have received 60% of this. So that is 24,000 they must have received. Total dividend paid is 40,000, out of which 60%, which is Ram's stake, on 1st November, and Ram credited it to its profit and loss, that is retained earnings. Second, the fair value of the plant and machinery as on 1st October was 4 lakhs, and the rate of depreciation on the plant and machinery is 10% unless given otherwise. This is percentage per annum. So this is giving you the fair value of plant and machinery. Maybe you can compare it with the WDV somehow to come to its fair value adjustment. Following are the changes in fair value. Okay, earlier you were given the fair value of plant and machinery. Here you have the changes in fair value as per the respective Ind AS from the book value on 1st October 11, which is to be considered while consolidating the balance sheet. So these are the changes in fair value. If it's a positive change, that's an increase in land and building, increase in inventory. It's a positive change, that's an increase in trade payables. Okay, prepare the consolidated balance sheet on 31st March 12. it may be assumed that inventory is still unsold on the balance sheet date and trade payables are also not yet settled. We have even given extra possibilities that what if they were settled or inventory was sold, and assume that other reserves on 31st March 12 are the same as that were on 1st of April 2011. So over here, first of all, what we will try to do is we'll try to prepare this blank Schedule 3 format of balance sheet. After that, we will write all the assets and liabilities, land, plant, inventory. You will not write the investments, trade receivables, cash. You will not even write the share capital, not even write the reserves, bank overdraft and trade payables. So you will write down all the assets and liabilities, if I'm not wrong, something like this. Over here, all the assets and liabilities will be written off. This thing on red, these adjustments you will do later. This total you will write later. So over here, you will have all the assets, all the liabilities. After that, you will write the share capital as well, in which case you would have considered share capital of the parent. This is 10 lakhs. After this, you will prepare a working note number 1, which is on consolidated reserves. Now, where you will start with the other reserves of the parent, that is 6 lakhs, and retained earnings. This is 1,14,400. So when you look at this, you will start with standalone 6 lakhs and 1,14,400. Leave around 6 to 8 lines. Working note 2. Well, is the question telling you how the NCI is to be calculated? No, which means you will assume the NCI is calculated using proportionate net assets, and thereby the goodwill that you calculate will be partial goodwill. Here you will take the investment. So this will be investment for a 60% stake. This is 8 lakhs. Because it is partial goodwill, you can minus directly the share in the net worth on 1st October. Share in the net worth on 1st of October. Well, over here, you will take equity share capital. The equity share capital over here is, for example, 4 lakhs. 4 lakhs into 60%, that is 2,40,000 is attributable to the parent, which I will get control on once I pay the 60% stake, and 40%, that is 1,60,000 is attributable to the minorities. So I will post the 2,40,000 here and 1,60,000 over it, and that's about it. So after I do all of this, the only two things that remain are this 2 lakhs and 1,64,000. So for this, I will prepare a separate working note 4, which is analysis of reserves, where I will take other reserves of 2 lakhs. I can see over here that other reserves as on 31st March 12 are the same as that on 1st April 11, which means during the year there was no change. So your opening balance was 2 lakhs on 1st April 11. And your closing balance is also 2 lakhs, which means the entire 2 lakhs is fully pre. There's nothing. But when I look at, for example, when I look at the retained earnings, I would say that the retained earnings are 1,64,000. Now, if I look at the opening retained earnings, they were 60,000. So if I do the analysis, I would say that, let us say the balance at the start on 1st April 11 is 60,000. Why will it change? Well, it will change due to the profits of the year 11-12, which I don't know. Why will it change? Well, probably because there is a dividend. Well, this is a dividend of 40,000 we have calculated, and hence I will get the closing on 31st of March 2012, which is 1,64,000, which means if I take the balancing figure over here, this will be 1,44,000. Now I will have to allocate this between pre and post. So if I look at pre, these are profits which are earned on or before 1st of October 2011. This 60,000 is entirely earned on or before 1st October 11, so it is fully pre. But this 1,44,000 we can assume is accruing throughout the year, and hence we can say 72,000, that is for the 6 months, will be pre, and another 72,000 which is for the next 6 months will be post. Acha, dividend over here is clearly given, it is out of this 60,000, and hence this dividend of 40,000 you will deduct, and thereby if you look at the analysis, this would be possibly 92,000 and this will be possibly 72,000, and this will be your analysis of the 1,64,000. So if I go to see the 2 lakhs is fully pre, 1,64,000 out of which 92,000 I believe is pre and 72,000 is post, and that is a breakup of 1,64,000. However, there are a bunch of adjustments. So at this point you leave around 8 to 10 lines for these adjustments. So over here, as you can see over here, once you do this 1,60,000, you will try to allocate, and at this point 2 lakhs pre, 1,64,000, 92,000 and 72,000. That's about it. Now you have two adjustments. One is a dividend. Now dividend you have already subtracted, but this is a pre-acquisition dividend and this is partial goodwill, in which case we are saying that there would be 24,000 of this dividend which would have gone in the consolidated profit and loss account. It is clearly told that Ram has credited it. the second of effect of which is not nullified through the post-acquisition profits, and hence we'll have to pass an adjusting entries. The goodwill will be wrong because the net worth as on the acquisition date, we are taking only 92, saying कि भाई 40 less हो गया. But if I go back in time to 1st October 11, on 1st of October, this dividend was not actually paid, it was paid on 1st November. And hence you want to increase the net worth. So credit the net worth by 24,000. You also want to debit the P&L because there is an income that you have recorded, but that is income from your subsidiary only. And as a result, your adjusting entry will be P&L or consolidated P&L account debit, which is in working note number 1, 24,000 your share. 2, let us say, share in the net worth 24,000. Had this been a full goodwill question, your entry would have been consolidated P&L account debit 24, N.C.I account debit 16, because the N.C.I would have also been come the dividend. 2, let us say, the pre-acquisition net worth of 40,000. So over here, this is your 24,000 and the entry over here 24,000 credit. So it will increase your net worth, and 24,000 over here is debited. So it will reduce your profit and loss. That's about it. Now, when you look at fair value adjustment, the fair value adjustment on, let us say, plant and machinery. Now, somehow you have to find the changes in the fair value of plant and machinery. So you will say the fair value was 4 lakhs. However, if you open the question, your balance sheet shows plant and machinery 2 lakh 70, but this is 2 lakh 70 on 31st March 2012. So I will say that what will be the plant and machinery on 1st October? Well, there is a data given regarding depreciation. That depreciation is at the rate of 10%. So you can say that, well, if 100 was the balance on 1st April 11, minus 10 rupees of depreciation will bring to 90 at 31st March 2012, which means if 2 lakh 70 is equivalent to 90, then 100 is equivalent to how much, sir? That will be 3 lakhs. And on 100, there will be a depreciation of 10. So that is 30,000 of depreciation. So will I take 2 lakh 70? No, sir. That is on 31st March 12. Will I take 3 lakhs? No, sir. That is on 1st of April 11. Which means I somehow have to find on 1st October 11. Which means if 30,000 is the annual depreciation, then for the first 6 months, the depreciation would have been 15,000. So this is 3 lakhs minus 15,000, and that will give you around 2,85,000. So something which is worth 2,85,000 will now be taken at something which is worth 2,85,000 will now be taken at, for example, 4 lakhs, and as a result there is a positive increase, a change of 1,15,000 in your plant and machinery. Other than this, all the changes are given. So your adjusting entry will be plant and machinery account debit. So this is plant and machinery account debit 1,15,000, land and building account debit 2 lakhs, inventory account debit 30,000, 2, let us say, trade payables, because you are crediting it 20. So these are all the changes. But where is the second effect of all of these changes going? Well, these are changes arising on the acquisition date, and then the second effect will go to the pre-acquisition P&L. So if I take all of this, 115, 230 minus 20, this is 3,25,000. If I am not wrong, 325 will be against the pre-acquisition retained earnings. So this is pre-acquisition retained earnings. If you see a working note, we would have done this. So 285, fair value change is 1,15,000, and these are the entries. This is 3,25,000 in the pre-acquisition. All of these adjustments you will give. Now, this is the initial adjustment. After that, there will also be a subsequent adjustment, but for the timing, we will look at the initial adjustment only. So this is 1,15,000 going in the plant, 2 lakh going in the land, 30,000 in inventory, and 20,000 in payable. Perfect. Again, there is 3,25,000 which is remaining. This is in the pre-section, initial fair value adjustment. This is in the pre-section 3,25,000. That's about it. Now, subsequently, well, plant and machinery can be depreciated. As per the fair value, which is 4 lakhs, the depreciation would be 4 lakhs into 10% into 6 by 12. So your depreciation will be around 20,000. However, in the last 6 months, your depreciation would have been 30,000 into 6 by 12, that is equal to 15,000. And hence, there is a need for charging an additional 5,000 of depreciation. This is for the period of 1st October 11 to 31st March 12. This is after the date of acquisition, and as a result, this 5,000 will be adjusted against the post-acquisition profit and loss. So it's an additional depreciation. So you will debit the post-acquisition profit and loss by 5,000, and you will credit the plant and machinery by 5,000. So your entry over here will be, so this is 20 minus 15, that is 5,000. Post P&L account debit 5,000. To, let us say, plant and machinery 5,000. And if I show these workings over here, post P&L 5,000 is reduced, and in the plant and machinery as well, another 5,000 is reduced. So that is perfect. Now what next? Well, we will try to calculate subsequent effects for land and building. Well, there's no depreciation rate is given, so we are assuming it is largely land for which there is no depreciation. If there was, you would have done a working similar to what you did for plant and machinery. Second, we go into inventories. Well, question has told you inventory is unsold, which means this inventory that you increased by 30,000 is still unsold and hence there is no effect. However, extra, if it was sold, then debit what comes in, credit what goes out. If inventory is going out, you would have credited the inventory additionally by 30. Whatever was there in your books would have already credited, but additionally due to the fair value adjustment by 30, and the debit will go towards the post-acquisition P&L. Remember, this is a post-acquisition effect and hence it could be taken against the post-acquisition profit and loss. So, this is post-P&L account debit to inventory. This is at 30,000. Okay. Further, if payables were paid, well, to bank would have gone, but they would have passed entry P&L account debit to bank. Ideally, it should be payables account debit to bank. So, payable account debit to, for example, post P&L. This is thankfully not there, but if it was there, these are the additional effects. After this, if you scan through, in this question, there is no other adjustment, and because there is no other adjustment, you can start totaling, where you will total in a backward manner. So, you will first try to total for these reserves. So, this is 2 lakhs, 4 lakhs 17, 67,000. Because this is partial goodwill, you will attribute directly. You can say 60% is attributed to RAM, 40% to N.C.I. So, 1 lakh 20 will go in working note number 2, 80,000 will go against working note number 3, 2,50,200 over here. Again, this is parent's share in the pre-acquisition. Parent share in the pre-acquisition retained earnings. So, this will go in working note number 2, and for everything pertaining to N.C.I, this will go in working note number 3. When I look at 40,200, this is what is the parent share in the post-acquisition profits, and hence this will go to working note number 1. So, if I go to N.C.I, 80, 166 and 26,800, all of this 80, 166,800 and 26,800, all of this will go in the N.C.I. When I look at parent share in the pre-reserves, 1 lakh 20 and 250,200, 1 lakh 20, 250,200 will go in the goodwill workings, and lastly the 40,200 will go in the consolidated retained earnings. Once I post the data for working note 4, then I will total up the other 3 working notes. That is, I will total up, for example, the N.C.I, which is at 433,600. I will total up and find the goodwill as 165,800. There is no further impairment adjustment, and I will total up the reserves at 6 lakh and 1,30,600. So, your total reserves will be 7,30,600. Your goodwill will be at 165,800 and your N.C.I will be 43,600. So, if I were to take this into my final balance sheet, as you can see in your final balance sheet, you will post all of these numbers, like your goodwill is a crucial number 165,800. Your N.C.I is 433,600 and other equity is 7,30,600. Other than that, everything else you will do plus minus, and these numbers you will take into your final balance sheet, and that's about it. So, this question has adjustments pertaining to partial goodwill, has adjustments pertaining to pre-acquisition dividend, and has adjustments pertaining to fair value changes. Okay, then there is another very interesting question that came, I think, in the January 21 papers. We will just discuss that as well. So, over here on 1st April 17, A acquired an 80% of the share capital of S. On the acquisition date, share capital and reserves of S are at 5 lakhs and 1,25,000 respectively. So, this is like your net worth as per book 6,25,000. A paid initial cash consideration of 10 lakhs. This is paid in cash. Additionally, A issued 2 lakh equity shares with a nominal value of 1 rupee per share at a current market value of 1.8 per share. So, as a part of the consideration, you paid 10 lakh rupees worth of cash and you issued 2 lakh shares of 1 rupee at the price of 1.8. So, this is 2 lakhs into 1.8 will come to 3,60,000, out of which 2 lakhs is in the share capital, remaining 1,60,000 will go into securities premium. It was also agreed that A would pay a further sum of 5 lakhs after 3 years. Okay, so this is deferred consideration, you have to pay after 3 years. A's cost of capital is 10% and the appropriate discount factor is given to you. So, these are the 3 factors. For you, the relevant factor is 0.5 and 75, and hence 5 lakhs into 0.75, this is 3,75,000 will be deferred consideration, which is a financial liability. Shares and deferred consideration have not been recorded by A Limited. So, there is an error in the SFS, we will have to rectify the error first. Below are the statements of financial position of A and S as on 31st March 19. See, all of this has happened on 1st April 17. 31st March 19 means this is 2 years away, this is plus 2 years. Okay. So, ideally, your entry that you must have passed is only for the cash consideration. All of this is given in thousands. 10 lakhs will equal to, I think, 1000 thousands. So your entry must be passed in the SFS as investment in B account debit 1000, that is for cash, to bank 1000. But that is not the correct entry. The correct entry should have been investment account debit to, let us say, bank. Let us say this is 1000, to equity share capital. This is 2 lakh shares or 200,000 shares at the rate of 1. So this is 200, to securities premium, the remaining 160. There is also a deferred consideration. To, let us say, deferred consideration payable. This is equal to, I think, 375. And hence, if I total all of this, I believe this will be what? 1360, 375. This is 1735. However, you have recorded the investment at 1000. As you can see over here, investment in S at cost is at 1000. To this, you will add 735 on the debits to rectify. But then you will have to credit it as well. Well, share capital will be credited by 200. There will be a new ledger for securities premium at 160. And there will be a new ledger for deferred consideration payable as well. This is a part of the liabilities. This will be, for example, at 375. This is rectification of the error, the first thing. Now, this is the entry for rectification on 1st of April 2017. However, 2 years have passed by. In the 2 years, will this 1735 change? No. Investment is to be shown at cost, so this will be at 1735 only. Will the share capital change? No. Will the securities premium change? No. However, will the deferred consideration change? Yes. If you remember Ind AS 109, deferred consideration is to be recorded using amortized cost principles, which means over here you would have done an amortized cost. Your opening balance would have been 375 plus finance cost at 10%, 37.5. So your closing balance would have been, for example, 412.5. On this, again, you would have had a 441.25, and hence this would come to around 453.75. Where say if you go to the third year as well, it will become 500. However, you want to see the balance on 31st March 19. On 31st March 19, the balance would have been 453.75, and as a result, if the balance is, for example, 453.75, there would be an additional finance cost of 37.5 and 41.25, that is around 78.75. This, if you had passed the correct entries, would have gone into the P&L, that is a retained earnings, and hence an adjusting entry over here would be P&L or retained earnings account debit of A to, let us say, deferred consideration payable. This is 78.75. Thereby, your retained earnings will reduce by 78.75 and your deferred consideration will increase by 78.75, and that ways the errors would be rectified. So over here, I think we have mentioned all of this over here. There will be a rectification. This is your correct entry. So your adjusted balance of investment, share capital, securities premium and deferred consideration, this is adjusted balance on 1st April 17. You will have to find the subsequent effects. This is over the next 2 years. There is no change in these items. However, the deferred consideration changes by 78.75, and hence the adjusting entry for this would be 78.75 will be adjusted, and thereby the adjusted balance of investment would be 1735, share capital 2200, securities premium 160, and deferred consideration payable will be at 453.75. Retained earnings will be 1321.25, and once you are done with this, this is where you can start the question in the usual manner. Okay, after this, other information on the date of acquisition, the fair value of S Limited's plant exceeded its book value by 2 lakhs. This is directly given to you. Like in the last question, you were given the fair value of the plant. You had to find a change of 1,15,000. Here, this is directly given to you that the fair value is greater by 2 lakhs. That's it. The plant has a remaining useful life of 5 years at this date. Okay, so there will be an initial fair value adjustment, and also due to depreciation, subsequent fair value adjustment, though it has been 2 years. Like in the last question, it was 6 months. Here, the additional depreciation will be for 2 years. The consolidated goodwill has been impaired by 2,58,000. This was not there in the last case. You will have to do the goodwill impairment case, and the A Limited Group values N.C.I using the fair value method. At the date of acquisition, the fair value of the 20% N.C.I was 3,80,000. So this is directly given to you, and hence you will take that. But now you will see how do you solve for N.C.I at fair value. You are required to prepare consolidated balance sheet as on 31st March 19. Notes is not required. Thank you very much. So first step, you prepare Schedule 3. When you prepare Schedule 3, it is a blank Schedule 3. However, here, because notes are not prepared, then in the bracket only you will mention 5,500 plus 1,500. Or inventory, you will mention 550 plus 100. receivables will mention 400 plus 200 and so on. So you will do all of that, then you will come to working note 1. In working note 1, you will start with standalone P. What is your standalone P? There are two reserves. One is 1321.25 for retained earnings and 160 for the securities premium. This is where you start. Okay, there is no change up to this point. However, here there is NCI at fair value. If there is NCI at fair value, when you calculate the goodwill workings, you will take investment, that is 1735, plus NCI, that is 380, and then minus you will have 100% of the net worth as on the date of acquisition. So when you look at this workings, this is your schedule 3 balance sheet. Then you look at consolidated other equity, start with 160 and 131.5, we have discussed that. And then when you go to the goodwill workings, you will start with the investment, that is at 1735, the rectified investment, and then the NCI at 20%, that is 380. Similarly, in the NCI note, you will directly put in 380. You will not again give a share in the share capital pre-acquisition reserves to the NCI because you are initially recording it at fair value. So your NCI will directly start at 1st April 17, 380 balance. Now you will go to working note number 4, but before that there is some share capital as well of the subsidiary, which is 500. Where will this go? Well, typically you do 80-20. However, that is if your goodwill is partial goodwill, you would say 80%. I'm going to take only my share of the net worth. Here I'm taking 100% of the net worth because I have to compare with the PC with the full NCI, and hence the entire 500, that is where question number, the earlier question and this question will differ. Entire 100% will be taken over here. Perfect. Now when you go into analysis of reserves, well, you will do the same working. How many reserves does the subsidiary have? Only one reserve, that is 300. You have been given on the date of acquisition, this was 1,25,000. So when you do the working, thankfully there is no dividend over here. You will say that your opening balance was 125. During the year there was some profit. During the 2 years there was some profit, which resulted in this closing balance coming to 300, which means we can say over the next 2 years you made 175 worth of profit. This 125 is within the pre column, whereas this 175 will go in the post column, and that is your analysis if you go to see. Now at this point you will, so this is 300, 125 pre, 175 post. At this point you will have to do the fair value adjustment. So in the fair value adjustment, there is an increase in fair value of the plant by 200. So your entry will be plant account debit 200 to pre-reserves. This was as on the acquisition date 200. So this is plant to pre-reserves. So when I look at the pre-reserves working, adjusted balance, initial fair value adjustment, this will increase by 200. Second effect going in plant. When I look at the plant, this is plus 200 in the plant account. But will there be any additional depreciation? Yes sir, for 2 years. On how much? 200 divided by 5 into 2, that is equal to 80 of additional depreciation, because 200 is the increase in fair value. Thereby the increase in depreciation would be 200 divided by 5 in 1 year. But from 1st April 17 to 31st March 19, it is 2 years, and hence 2 years of additional depreciation is worth 80. This is 2 years after the date of acquisition, and hence your entry will be post P&L account debit or post retained earnings account debit to plant. So plant will be credited by 80, and in your post retained earnings you will credit this by 80, and that's about it. So there is goodwill impairment as well. Well, we'll first try to find a goodwill and then do the impairment adjustment, though you can even do it alternatively. So you have taken NCI at fair value, you have taken the fair value adjustment, which is goodwill which is remaining. So we'll first find a goodwill and then do the impairment. So over here what you will do is you will try to total up, and once you total up you will find this is 420 split between 325 and 95. Now 95 is post acquisition profits. 80% of that, that is 76, will go to the parent, working note 1. 20% of that, that is 19, will go to the NCI, working note 3. However, when I look at, so as you can see over here, this is I think 76 and 19. But when you look at, for example, the pre-acquisition reserves, remember the entire pre-acquisition value, whether it is purchase consideration or NCI, is going in working note 2. So the entire pre-acquisition section will go to working note 2. This is where you have to avoid making a mistake. Typically we split between 260 and 65. You can split that, but you should ensure that this entire 260 as well as 65. Sir, why? And NCI on acquisition date is in working note 2, and hence NCI share in the share capital or the pre-acquisition reserves will also go in working note 2. So this is 260 as well as 65. Both of them will be taken over here, and thereby you will attribute, let us say, this pre-acquisition reserves of around 325 will come entirely over here. Now if I sit and total up now. We have given this. So if I sit and total up this is 825, and hence their full goodwill comes to on 1st April 17, 1290. But out of this, there has been an impairment which is given to you in the question of 258. But this is a full goodwill question. Will the 258 entirely be taken by the parent? No. 258 into 80%, that is equal to 206.4 by the parent. The remaining, for example, 51.6 by the N.C.I. So your journal entry for impairment would be consolidated P&L account debit 206.4, N.C.I. account debit 51.6, to goodwill 258. So if I go to see minus 258 for the goodwill, so this is 1032. N.C.I. debited by 51.6, and goodwill impairment in the parent debited by 206.4, and that's about it. Once you take this 160 and 1190, so this comes to what? Your total reserves of 160, 1190, that is 1350.85. Goodwill coming to 1032 after writing off the impairment, and N.C.I. coming to 347.4, and that's about it. So over here, it's a very good question, which is a blend of financial instruments for deferred consideration calculation. It is a blend of business combination for calculating the PC and investment value correctly, and it is also a blend of consolidation. So this is a very good question. Also, small nuance which can be there is deferred consideration, which was earlier payable after 3 years. 2 years have gone by, 1 year is remaining, and hence ideally the deferred consideration, if you now show, it should appear as a part of the current liabilities in the financial liabilities. Earlier it may be non-current, but on 1st April 2019, the next payment is due just 12 months away, and hence it will now be a current liability. So this kind of takes care of question regarding this N.C.I. at fair value. Now the next concept over here, which is also one of the institute's favorite questions, which is question number 18 at most of our books, which is on chain holding. So when you look at the chain holding question, you have a consolidated balance sheet as on 31st March 12 of the P group. So you have P, S and SS. The important points over here are investments. Okay. How do I know, sir, it is a chain holding question? Well, investment in S is appearing in P's books, investment in SS is appearing in S books. If it was a parallel subsidiary question, then this 280 would have appeared over here. Both of them would be in the books of P. Here, 280 is appearing in the books of S. Other than that, you have this entire balance sheet. There is some bills payable which are intercompany, and samne this can be bills receivable as well. Okay, P holds 80% in S, and S holds 75% in SS. Their holdings were acquired on 30th September. Thankfully, they are acquired on the same day. There was an exam question where they were even acquired on different dates. So over here, there is P holding 80% of S, S holding 75% of SS. Does P control S? Yes. So does S control SS? Yes. So does P indirectly control SS? Yes. Which means when I do consolidation, I will take over the assets and liabilities of P, S as well as SS. Further, if I want to do the calculation for N.C.I. over here, I would say, how will I do N.C.I.? Well, P's effective stake in SS would be 80% into 75%. So this is what 80 into 75 comes to, let us say, 60%. So this is 60%. Therefore, N.C.I. will be how much, sir? N.C.I. effectively will be 40%. Whatever are the net assets in SS not attributed to P, which is 40%, is the N.C.I. in SS. On 1st April 11, this is 6 months before the acquisition, the following balances stood in the books of S as well as SS. There are some reserves, there are some retained earnings for S as well as SS. 10 lakhs included in the inventory figure of S is inventory which has been purchased from SS at cost plus 25%. Okay, so this is SS having sold to S. So this is like an upstream transaction. Now I can say that this is included in the inventory figure of S. So this must be the selling price for SS but cost price for S. So the profit is 25% plus cost. If the cost was 100 plus 25 is equal to 125. If 125 is equal to 10 lakhs, then 25 is equal to how much? So this is, for example, 10 divided by 125 into 25, this will probably come to 2 lakhs. So the unrealized upstream profit over here is 2 lakhs. The parent company has adopted accounting policy to measure N.C.I. at fair value. Question is given you. Had it not given, we would have taken N.C.I. at proportionate net assets by applying 103 and assume market prices of S and SS are the same as respective face value. So this makes it very easy. The total face value is already given over here. So if I want to find the market value, this is the share capital at face value only. I can directly multiply the NCI percentage and get the market value. So how do we solve for this, sir? We will first prepare our Schedule 3 balance sheet format. We will, after preparing the Schedule 3 balance sheet format, prepare our notes where you take over all assets, all liabilities, show the NCI working as well, and then over here P is working in S. In S, I have an 80% stake, so 20% is NCI, date of acquisition is 30th September. In SS, 60% effective stake, which means 40% is going to NCI, again date of acquisition is 30th September. You prepare your regular Schedule 3 format, you prepare all assets and liabilities, and then you go to working note 1 where you take the reserves. The reserves over here will be the reserves as appearing in the balance sheet of both S and SS. Of P to start with, reserves at 180 standalone and 160. So you will take 180 and 160 in the usual manner, nothing tricky over here. Now the problem will arise when you do goodwill workings. You will start with the investment. You will say first investment is appearing in whose books? Sir, investment is appearing in P's books, and all assets of P 100% are attributable to P only. So this is investment of 340. But this 280 is appearing in whose books? Sir, in S Limited's books. And S Limited's assets and liabilities, it is in SS books. It may be investment in SS, but it is appearing in the books of S, are appearing. So 280 into 80% will come to 224. This is 224 attributable to the parent, whereas the remaining, for example, I believe 200, this is 56, which is attributable to NCI. So the elimination entry over here in the cost of control will be 224 for investment, and 56 will be deducted. It is the entry will be cost of control account debit 224, NCI account debit, for example 56, to investment 280. So NCI will be debited. So you will reduce the NCI by 56, and investment attributable in the cost of control will be around 224. So when I look at this, this is the crux. I would say this is the place where most students do make a mistake. Investment in this is 340, no problem. This is 224 is where the problem is. And then when you go into the NCI working right at the end, in the NCI you would say this is minus share of investment, share of S Limited's NCI in SS. So this is 56, you subtract from the S section because this is attributable to NCI of S as per ICAI workings as well. Now this is NCI at fair value. If NCI is to be calculated at fair value, before you go to the workings further, you will find a fair value. Like you have said that what is the NCI in SS? This is 20%, and in S is 20%, in SS is 40%, which means 40 into 20% will give you the market, 400 into 20%, that is 80 will give you the market value. 320 into 40% will probably be what? 128. This will also give you the market value. So when I take the NCI's market value, this is 80, this is 128. Similarly, I take over here, this is 80, this is 128. Now I'll have to subtract 100% of the net worth as on the acquisition date. So for the equity share capital, the entire 400 and the entire 320 will be taken over here. 100% I have to take. Okay. With this, the only thing that is remaining is reserves, and if you are able to crack this 224 and 56 file adjustment fairly well, you will be able to manage the reserves. So if I look at S, for example, in S, what are your reserves? Sir, your reserves in S were 80. Beginning mein, closing mein, this became 100. So I can say that there was 80 at the beginning. During the year, you must have earned 20, and hence closing mein it became 100. Acha, 80 is fully pre. 20 is earned throughout the year, and hence 10 will be pre, 10 will be post, and as a result this is 90 and 10. Same way you do for retained earnings. When I look at retained earnings for S, this is 20. Well, 20 was at the acquisition date, now it has become 50, which means if I do the working, I would say, well, 20 plus 30 will equal to 50. 20 is fully pre, so 15 and 15 will come over here, so this is 35 and 15. There is no adjustment. Upstream profit will be adjusted in SS books. Now this 90 and 10, this 35 and 15 will go in what ratio, sir? 80-20, because these are reserves appearing in the books of S. All assets, all liabilities, all reserves in the books of S will be split in the 80-20 ratio. So this 10 80-20, this 15 80-20. Okay, technically you can do the same for 90 and 35 as well, but because you are calculating NCI at fair value, this entire 90, whether you split 80-20, and the entire 35, whether you split 80-20 or not, will go into the pre-acquisition section. 100% of your net worth has to be calculated. So when you look at this, this is 90 and 35, जो हमने अभी बोला. And apart from that, when you look at this 10, 80-20, 8 rupees will come over here, 2 rupees will go to the NCI, Then there was 15 into 80%, I think will be 12 rupees will come over here, and the remaining 3 rupees will go to the NCA. And that's about it. The same working you will do for SS. Just that when you do for SS, the ratio has to be 60-40, because that is the effective stake for P. So when I look at SS, for example, I would say that in SS, we have reserves of 60 to start with. At the end, this is becoming 80. So this is, if I look at SS, 60 becomes 80. So 20 rupees is the profit. 60 is fully pre, 10 and 10 is split, and hence 70 and 10 will come for reserves. Similar working for retained earnings, which was, I believe, 30 over here. Closing comes to around 60. So 30 will be earned during the year. So 15 and 15. So 45 and 15. Now there's an upstream profit in this case of 2 rupees as we calculated, which must be there in the books of SS. When was the sale happening? We don't know. So in line with the institute solution, we assume that the sale happens at the end. In which case, end meaning in the post-acquisition period, in which case you will assume that this 2 rupees must be in the post-acquisition profit section. So post P&L of SS will be debited and inventory will be credited. So this will be post P&L debited by 2 rupees, inventory credited by 2 rupees, and thereby you will get this 45 and 13, 70 and 10. Now in what ratio will they go? Well, 60-40. This is the important thing. They will go in the ratio of 60-40, because ultimately how much will reach P? Only 60%. The remaining 40% will be leaked out to the NCI. Again, because it is NCI at fair value, the entire 70 and the entire 45 will go over here. And when you look at 60-40, 6 and 4, 7.8 and 5.2 will be taken. So this is 6 and 4, 7.8 and 5.2, and that's about it. Once you do this, you will total up everything, and this will be 166.2 of NCI. There will be around 188 of capital reserve. You can even show it as a gain on bargain purchase, but usually if there are reasons attributable for this, you can show it as a gain on bargain purchase. Otherwise, directly show it as a capital reserve, and your total consolidated other equity will possibly come to around 194 plus 179.8. But because there is no goodwill, there is capital reserve, you will add the capital reserve as well, and 561.8 will appear. So that takes care. Other than that, there are certain bills receivable and bills payable intercompany that you will eliminate. So over here, there may be a total of bills payable of 70 and 30 intercompany, that is 100, and some bills receivable of 72 and 30. So maybe 102 of bills receivable and 100 of bills payable. So there will be 2 maybe net bills receivable which will appear. So ultimately there will be 2 worth of bills receivable that will be appearing. 7, none of the bills payable will appear. And other than that, you will just total up all the line items 100% and you will get your answer. So the crux over here in chain holding, in my opinion, is only 2 things. First, if you are able to calculate the NCI stake properly, like the 60-40 stake, and secondly, if you are able to figure out how to eliminate the investment done by S in SS. You can't just eliminate it against the goodwill workings. A part of it will go to the goodwill, a part of it will go to NCI. How much part? You will have to always ask yourself that this amount is appearing in whose balance sheet. It can be equity share capital, it can be reserves, it can be investment. You ask yourself, it is appearing in whose balance sheet. If it is appearing in the balance sheet of S, it will be split in the ratio of 80-20. If it is appearing in the balance sheet of SS, 60-40. If it is appearing in the balance sheet of P, you don't need to split it at all. So that is something that you have to be careful about. Now in one of the exam questions where this had come, they had changed these dates. One of this date where P was acquiring in S was different, and where S was acquiring in SS was different, in which case when you split these reserves, what are you doing? In every one you are saying, okay, acquisition is in the middle of the year, which means 50-50. That may not happen. If the acquisition was at the start of the year, that you don't need to do 50-50. Like 20 was there at the beginning, 30 was earned during the year. We said 30, 6 months pre, 6 months post. No, that will be because date of acquisition is 30th September. If the date of acquisition was not 30th September, you don't need to do this split working like that. Okay, so that takes care of question number 3. Now another very important question is question 4, which is a November 23 exam question. Now this is question 40 in our books. I will just briefly discuss this question. Okay, if you want a very detailed video on this question, we have uploaded a separate November 23 video for close to an hour where I am discussing this with all the alternative possibilities. I'll put the link for that over here as well. You can review that if required. Otherwise, have a broad understanding of this question. I think you are then good to go. So let us review this question. So you have the balance sheets of Hammer and its subsidiary Sleek on 31st March 23. So you have the entire balance sheet given over here, and Then you have notes to accounts, plant and machinery, there's already some goodwill, general reserve, 8% debentures of 100 each. So Hammer acquired 20,000 equity shares of Sleek on 1st April 22 at a cost of 2,40,000 and further acquired 17,500 shares on 1st October 22 at a cost of 1,92,500. So if you total both of these, your total will be 37,500. 37,500 on the base of how much? Unless given otherwise, let's say this is 5 lakhs of 10, so this is 50,000, 30,000 based on 50,000, that comes to 75% stake. So initially when the 20,000 shares were acquired and then 17.5 thousand shares were acquired, when the 20,000 shares were acquired, I believe you had a 40% stake and then you acquired another 35% stake, and hence you can say that which date did you acquire control, that is when you will start consolidating. 1st April 22 was 40% stake and 1st October 22 was when the control was acquired at 75% stake, and hence your consolidation will start from 1st of October 2022. But if this is an additional stake acquired after control, this is an additional stake acquired which gives us control, and hence your existing investment of 2,40,000 will have to be remeasured to the fair value. We'll have to figure out how to remeasure it, but will have to be remeasured at fair value. Okay, then we have 8% debentures of Sleek, include debentures held by Hammer of the nominal value 35,000. Those are acquired by Hammer on 1st January 2022 at a cost of 84,000, which means this is intercompany, you will have to eliminate it. So your entry over here will be, you will eliminate the investment by, I believe, 84,000. You will debit your debentures by, let us say, 35,000. I'm sorry, I don't have place over here. So your debentures will be debited because the liability will be debited by 35,000 to investment. Investment will be credited by 84,000, and hence there is a balancing figure which is what, 84 minus 35. There is a 49,000 loss, and this 49,000 loss will be taken into the consolidated P&L account. I'm just discussing the adjustments. We'll do the process. The retained earnings of Sleek had a credit balance of 75,000 on 1st April 2022. This is 6 months before the control being acquired. On that date, the balance of general reserve was 50. That is fine. Sleek had paid dividend of 10% on its paid up share capital out of the balance of retained earnings on 1st April 22 for the financial year 21-22. The entire dividend is received by Hammer and was credited in the statement of profit and loss. Okay, the problem over here is when you look at this adjustment, and there are multiple solutions over here, I'm just doing the way Institute has done. If you want more detailed alternatives, we have discussed it in the video for November 23. So what is your total dividend? Sleek had paid 10% dividend on its share capital, 5 lakhs into 10%. So this will be around 50,000 of dividend paid by Sleek. But when has it paid? Well, we don't know, because if it paid in the first 6 months, then this is dividend which is paid even before control was acquired. If it is paying in the last 6 months, then it is dividend paid after control was acquired, and hence you will have to do certain adjustments to find the correct net worth. But if it is paid before control was acquired, then how does it even matter? So Institute over here has assumed that this dividend was paid in the first 6 months. Though an alternative solution would have been possible. As per resolution on 20th February, Sleek allotted bonus shares at the rate of 1 share for every 10 shares held out of the general reserve. The accounting effect has not been given, in which case we will ignore it. Ideally, what could have been the treatment? If the accounting effect was given, we would have passed an entry to reverse it. So that, because bonus is a book entry, but if the accounting effect is not given, that is best, so we'll ignore it altogether. So bonus over here is ignored. Even Institute, I believe, can ignore it, or you can take the effect where you can give the effect for bonus and then do the adjustments, though I would prefer to ignore it. I think Institute over here has given the effect for the bonus and done some workings. We have given that in our alternative solution as well, but ignoring bonus is very much possible. It is easier. Trade receivables of Hammer include bills receivable of 2 lakhs drawn upon Sleek. Out of these bills, 50,000 has been discounted with the bank, which means intercompany elimination will be done for the remaining 1,50,000. During the financial year 22-23, Hammer purchased goods from Sleek. Hammer purchased from Sleek. That means Sleek sold. So this is upstream of 25,000 at a sales price of 30,000, which means there is a 5,000 unrealized profit. 40% of these goods remain unsold. So 5,000 into 40%, that is equal to, I believe, 2,000 will be the adjustment for upstream unrealized profit will be done in the books of Sleek. On 1st October 2022, machinery of Sleek was overvalued by 20,000, for which necessary adjustments are to be made, which means when I acquire Sleek, there is a machinery where there is a fair value adjustment of 20,000 to be done. Depreciation is charged at 10%. So over here your entry will be, initial fair value adjustment will be pre-acquisition retained earnings account debit 20,000 to, let us say, plant and machinery 20,000, and then subsequent depreciation, loosely speaking, at 20% of 10% of 20,000, that is 2,000 into 6 by 12. So this is 1,000. ICAI is done. Loosely speaking, this is 1,000. The parent company, that is Hammer, has adopted the accounting policy to measure N.C.I. at fair value, that is quoted market price. Assume fair value is 11 rupees on the date when control was acquired by Hammer, which means, well, there were 50,000 shares, out of which 37,500 were held by Hammer, which means there is a remaining 12,500 shares. These 12,500 shares were held by N.C.I. 12,500 into 11, that is equal to 1,37,500. This would be your N.C.I. At the same time, your investment has to be remeasured. Your investment was 20,000. It was acquired for 2,40,000 into 11. If you go to see, this is 2,20,000, and hence your investment of 2,40,000, which was there earlier for the 20,000, has a fair value of 2,20,000, and hence this investment will be down valued. So this is P&L account debit 20,000 to investment, let us say 20,000. So based on all of this, you are required to prepare a consolidated balance sheet as on Hammer and subsidiary sleek. This was a compulsory. This was the last of the 20-mark question. In November 23 is the last attempt where you were not having MCQs. After that, you have MCQs. So Institute took the opportunity to have the biggest possible question, and they gave this in the compulsory section. So this was November 23 exam question. I would put this as a very good question for LDR because it has upstream, it has multiple investments, it has bonus, it has dividend, it has you name it, it has everything, fair value adjustments, intercompany debentures, so everything is there. So what you do is you prepare the Schedule 3 balance sheet. After you prepare the Schedule 3 balance sheet, again you calculate how much is the NCI, how much lot that you have, you put all the assets and liabilities over here, and then you do consolidated other equity. Within consolidated other equity, you start with standalone. Both the balances as are there given in the question, you will take them as it is. This is 2 lakhs, 3,50,000, and when you take the investments, this is where there is an interesting adjustment. When you take the investments, you will have investment for a 40% stake, which was 2,40,000 minus 20,000. So this is 2,20,000. So in your standalone P&L, there's an adjustment of 20,000, as you can see over here. This is entries. Investment is credited, P&L is debited. So this is 2,20,000 and another 1,92,500. So this will give you a total PC in a way of 4,12,500. Now the problem over here is this is NCI at fair value, which means the 137,500 of NCI will also be added over here. So this is 137,500. Okay. In your NCI, your opening balance of NCI will be 1,37,500. Okay, after this, you will eliminate the 100% of the share capital. Well, bonus ka effect has not been given. We will ignore the same, and hence your entire 5 lakhs of share capital will be eliminated over here. Then you go to the reserves. When you go to the reserves, you will take the total general reserve. The balance at the start is 50, 75, closing is 1,25,000 and 2,50,000. See, the effect of bonus has been ignored, and hence I have not taken it over here because wo books mein aaya hi nahi hai. It has not come in the books. Dividend is there in the books. Dividend must be paid at 10% of 5 lakhs, that is 50,000, and it is paid out of the reserves, which is prior to the date of acquisition. It is paid clearly given to you out of the reserves prior to the date of acquisition. It is dividend for the year 21-22 before your acquisition date, and hence would be paid out of the reserves of that period. So this is minus 50,000, which is coming from the pre-acquisition reserves. Now once I do all of this, I'll find a balancing figure for reserves, general reserve and retained earnings during the year, and because the acquisition date when control is acquired is 1st October, you split it 6 months, 37,500, 37,500, 1,12,000, 1,12,000, and that's about it. Now after that, all the fair value adjustments, that is, you will have initial fair value change of 20,000. Secondly, you will have the additional depreciation we calculated as 1,000. In this case, depreciation will not be additional, it will be reversal because your plant and machinery was overvalued. So you will bring the value down by 20,000. That means your depreciation as per fair value will be lower as compared to what is there in your books. Your entry will be post P&L will be credited, plant will be debited by 1,000. Okay, and there was some unrealized profit that we calculated of 2,000. If nothing is given, we'll assume this is after the date of acquisition. So all of these adjustments we have taken care of, which we discussed. We found the adjusted balance. This entirely will go to working note 2. This entirely will go to working note 2, and then the post balance, like discussed earlier, will go into the respective values. So as you look at these adjustments, we are assuming the dividend is paid before 1st October. If it is for 21-22 it is reasonable that it must be paid before 1st October. So no adjustments are needed to adjust the net worth on 1st October. Prior to 1st October, the shares were held in the nature of investment and dividend on them should have gone to the profit and loss. Hence, no adjustment. No adjustment. This is exactly what ICAI has done. Though we have given alternative solution, had the question told you that the dividend was after 1st October, then this would have been dividend out of pre-acquisition profits, in which case you will have to pass an adjusting entry separately of dividend from, so P&L account debit for the 75% stake, N.C.I. account debit because this was full goodwill, to let us say pre-acquisition net worth if it was after. So we have discussed it separately as an extra point. I am not discussing it right now for keeping it more focused. Next, we have elimination of intercompany debentures. 8% debentures are 35,000, investment is 84, and this will go to consolidated earnings. As you can see over here, this 49,000 will be taken into the consolidated earnings, loss on elimination of debentures. Okay, bills elimination is only for 1,50,000 because 50,000 is still a liability to be paid to the bank unless profit is 2,000. Fair value adjustment is for 20,000. You will reduce your machinery, and then there is a saving of depreciation of 1,000. There could have been an alternative interpretation in this 1,000, but to stick to it, this will be the case. Okay, for bonus, we will reverse the effect of bonus since it is a book entry. Ignore bonus adjustment since entry for bonus is not passed only. This is what we have done. Though you can pass the entry for bonus and then adjust, like what ICAI has done over here. You can refer the alternative treatment as well separately, though your answers will remain the same. So I'm not going into too much complexity. In any case, this question has too much to take care of. If this comes in the same form, leave this question. It's a 20-mark question. For 14 marks, it is not worth doing. It will take ages to solve this question, but I'm pretty sure it will not come in the same form. There would be certain adjustments of this question that can be borrowed. If you want to review this in detail, it's more of a 1+ hours discussion, which we have done separately, for which we will share the link. Okay, so these are the top questions. Though even beyond this, if we want to discuss a few questions, we'll just try to review. If there is one question on stake sale, one question on stake purchase, we can just discuss a few of them so that we have a full enough, good enough understanding. So this is from our main books. You might see a bit of things marked over here, but since maybe I can spend 10-15 minutes more so that you get a more rounded of overall understanding. So if we look at a stake acquisition question, let us say A acquired 70% of shares on 1st of April 10 when the fair value, okay, just a second, if I just do another simple question only, A acquired 10% of the additional shares of its 70% subsidiary. So it is already 70%, so this is after control is acquired. The earlier question had control. In respect of change in N.C.I. on the basis of balance sheet as on 1st April 2010. So over here, if I look at the balance sheet in SFS, investment is at 14,000, purchase price of additional is 2,600. In the CFS, N.C.I. is at 6,600. Well, this is for a 30% stake. Then for 10%, this N.C.I. will possibly be 2,200. Consolidated P&L and goodwill. So what will be your entry? Well, your entry will be, this is purchase of N.C.I. So N.C.I. will be debited at 2,200. Let us say investment will be credited at 2,600 because that is what you have done, and hence the 400 will be loss on creation of N.C.I. and this will go into other equity. So this is a case where you look at let us say transactions where you are doing a stake purchase which results in after control is acquired. There's another problem if we can discuss regarding this. This is on stake sale, for example, after control. So if you look at question number, I believe 24, Reliance has a number of wholly owned subsidiaries, Jio Infocomm being one of them. The consolidated position of that is given to you. So you have been given all of this data. So you have this big balance sheet and you have been told that prepare balance sheet after disposal as per 110 when Reliance sold 90% of shares in Jio to an independent party for 1,000. Now there were wholly owned subsidiaries, which means I am holding 100% in each of them and I am selling 90%. That means there is a loss of control, but I am retaining 10% stake. Now they have not told you what method to be followed, in which case we will assume that we will follow the proportionate method. You will calculate the carrying value and find the proportionate method. So over here, if you want to calculate the carrying value, you can say group carrying value of Jio Infocomm, all of this including goodwill, 1730 minus 450. So 1730 minus 450 comes to around 1280 because it is a wholly owned subsidiary. There is no N.C.I. I will say out of this 90% is sold, 10% is unsold. So into 90% comes to 1152. So for something worth 1152, you are getting only 1000, which means there's a loss of 152, and remaining amount will be shown as 128. So when I look at the journal entry, I would say that bank account debit, I'm getting 1000, investment retained 128, two net assets, all of them I will remove, including the goodwill, 1280, and there is a balancing figure of 152 loss. What will I do? I will remove every asset. As you can see, 190 minus 90, 1620 minus 670. I'll show a separate investment at 128, remove everything. 152 will be reduced from the retained earnings. It is a loss, and that's about it. So if there's a stake sale which is resulting in loss of control, I will remove the assets and liabilities. I will bring in the investment. I will find the gain or loss and adjust it in the profit and loss account. Okay. If you look at another question, let us say this is one basic stake sale question. If I look at, let us say, exemption from consolidation. So if you want to look at the exemption from preparing, following is a structure, there is X, there is A, and there are companies B and C. You have been told X is a listed entity in India. X is the ultimate parent. Okay, so that is listed. Prepare CFS as per Ind AS. A is an unlisted entity, not in the process of listing. X does not object to A not preparing the CFS. Whether A is required to still prepare CFS as per requirements of Ind AS? The answer is no, because A is an unlisted company. It is an intermediate company, and it is wholly owned by X, which means you don't need any permission from anyone else. So it does not need. Assume safe X in A, except that X is a foreign entity and is listed in the stock exchange of a foreign country. Okay, then the ultimate company is no longer X, it is now A, and prepares financials as per GAAP of that country. Will your answer be different? Yes, A is the ultimate company as per Ind AS, and hence there is no exemption. It will have to prepare CFS. The same facts as scenario A, except 100% of investment is held by Mr. X, who is an individual instead of company X. Will your answer be different? Yes, because the ultimate entity is now no longer Mr. X. The ultimate entity is company A, and company A, because it is an ultimate entity, it cannot claim any exemption. Again, it is possible that in the first scenario, there was no 100% holding, there was 80% holding, 20% was held somewhere else, in which case I'll have to give an intimation to those 20% people, and if there's no objection raised by them, in that case we can prepare our financials, we can claim exemption from preparation of our financials. Okay, then there are a few other sums regarding investment entities, etc. So I believe that largely takes care of majority. Okay, there was this one very daunting question which had come in the RTP of November 2023. It is, Institute had taken this from the ACCA material. It is quite a challenging one. This I have solved again a 1 hour question from November 23. I'll just put up the link for that and you can refer that separately. There are a few other recent consolidation questions. Almost all of them I've solved separately on YouTube. I just try to link up the links if you want more questions for which, but I would say that this RTP question, it is good to know. If you don't do it, we have not even put this for our LDR, because in ACCA you have a computer, you literally have the computer and Excel sheet, and this is a 25-mark question which is solved with the assistance of a computer. RTP, they can give everything. I really doubt that a question like this will make it to the main exam, but if you want to do, that is a question that can be referred on. And I believe this is a Hammersley question. I believe that should be it. We have tried to complete as much as possible for this in less than 3 hours. I really hope that this session was helpful to you. If yes, please do show some love and press the like button, share it with your friends, and keep studying, keep learning, keep smiling, and I'm sure you are going to do exceedingly well. Keep on the good work, and if you need any other content, any other help from my side, please do put it in the comments and we'll try to incorporate as much as possible. Okay, so that should be it for today. Lots of love, lots of good wishes for you, and see you soon. Bye bye, take care.